remain very low, right, continuing claims are rising. So people are not getting reemployed as easily. So there are pockets of weakness here, and it was all over the Beige Book, which informed the Fed meeting, right? And it's all anecdotal, but the Fed knows, and we think we know, it's going to start showing up in the data.
What's more important, the backward-looking labor market report or the fact that in the earnings of Starbucks and Chipotle, people are still willing to pay $7 for lattes and $11 for burrito bowls and are buying them in incredible amounts?
Yeah, so I think when you tie the labor market to consumer spending, obviously labor income matters for most Americans, and it has been slowing, right? Slower wage growth, but still robust job gains. The growth rate in labor income is slowing. But the discretionary spending, and especially on the upper middle to wealthy households, is still very strong. And as long as we're creating jobs, that demand for coffees, we used to follow coffee and sugar over the business cycle. And when coffee and sugar weakened, you knew that we were getting to the end of a labor market cycle. So it's good news that we have a strong labor market, and guess what? We're still reporting to work each day and having that coffee, and we're willing to pay for that specialty item.
I want to go Angus Madison on you. If we had a demographic shift where we have to get used to a reset in the unemployment rate lower, I look at Topeka, Kansas, 2.9%. Clearly the run rate before was a higher number, 3.54%, whatever the conversation is in the heart of Kansas. Do we need to shift down, almost like we're arguing about our STARD, do we need to shift down our unemployment rate to a new level because of demographics?
Well, I think that there's plenty of argument of why full employment can be had at a lower unemployment rate. But where is that unemployment rate, right? Full employment, R-star, potential growth, these are made up numbers almost. And how do you know you're at neutral for the interest rate? You don't. You know it probably when you passed it up and you get a disaster on your hands. That's how you know where the neutral rate was. So the Fed believes it's around 4% for full employment. That means that we've got a tight labor market.
Okay, but is that a theory? Is that as goofy as a plug-in like our STARD? I mean, 4% is normal. Says who?
Right. So is it as goofy? Again, these numbers, it's trying to put economic theory in practice. And theory would tell you that the demographic shifts, the fact that companies are labor hoarding right now, that you can have full employment at a lower unemployment rate, which means we're not as tight as you'd think, right? But it's in theory. You don't know. In practice, you know if it's a very tight labor market, if suddenly wage growth is spiraling out of control, for instance.
A lot of people have been talking about artificial intelligence this year. I don't think we're going to see it necessarily in these numbers, but it really underpins the angst that we've seen in some of the strikes, whether it's UAW or whether it's in Hollywood. How are you modeling out whether this means that fewer people are going to work because everyone's going to be replaced by a robot? Are we starting to see any of that in the data right now?
So I think AI is an exciting trend. I think it's something that is difficult to pinpoint in real time. I think that we are very encouraged that it can alleviate some of the pressures from the shortage in workers in semiconductor industry, manufacturing workers. We just don't have a deep pool of manufacturing labor. And so the more that we can tech out facilities and build more manufacturing facilities that are higher tech, you're going to create a lot of job opportunities in that area, and you're going to alleviate some of these shortages in other areas, right? So I think of AI as a technological advancement similar to periods in the past where there's a temporal problem. You're going to have displaced labor in the short to medium term, and over the longer term, you're going to see labor really increase in other areas.
Let's talk about the short to medium term and theory. You mentioned theory. Does Chairman Powell have one? And if he doesn't, is that a good or bad thing?
Well, his theory is probably a little more tangible than basic economic theory, and that is the data is going to tell me what to do. And yes, there are data that's lagged, but I'm nimble. I can move quickly. I can bob and weave with the data when it comes in, right? And so that nimbleness is something that that I believe he felt confident that he achieved in 2018 going into 2019 when the Fed pivoted very quickly and moved to the sidelines and started to cut. And it looked like things were stabilizing, and then COVID hit. So you've got a chair that should be very confident that, hey, I've done this and I can do it again. And do it again in order to maintain a soft landing in the economy.
Alan Zender, thanks for your view. Alan Zender of Morgan Stanley. If you are just joining us, welcome to the program. We are counting you down to that payrolls report. The median estimate in our survey is 180,000. The price action going into it looks like this in the bond market. What a turnaround we've seen over the last couple of weeks, from 5% moving back on a 10-year to 463.87. We're down 2 basis points. In the equity market, we're negative here by 0.08%. The equity market this week, Tom, up big time, in line with this rally we've seen in the Treasury market as well.
A big time, and the way it's up is great. And what I've been trying to do is get a gauge here on where people are positioned. And I get different readings. I don't have a strong opinion on this, other than to say there are select charts that show there's a lot of people that really don't want to be in the market. I wonder how that changes the tone.
Well, I take your point. A lot of this does have to do with positioning and how much of the short positions in treasuries has been wiped out and sort of set a new slate for whatever is to come. And I take your point also with positioning and the bearishness. Michael Hartnett, who you were talking about earlier, John, came out and basically said, well, it kind of looks like we could get a rally. And he's been bearish all year, and yet he's seeing the underpinnings of something into a year-end rally. So not a lot of bearishness. I'm just saying the gloom is not that gloomy.
But then the question is, does that have enough inertial force to break out through support or resistance, depending on which way you're going? I haven't seen evidence, and maybe the reading over the weekend will be, you know, give us some color on that, particularly after the jobs report of, okay, now what? And do we get going? My basic answer is we're off the October lows. I mean, a guy like John Stolfus, these bulls, Ed Yardeni, John Stolfus, and the others, they look awfully good off October.
They're less constructive, Tom, over the last week.
Yes.
Both of those individuals that you named. It's amazing to see this tone shift, though. 35 basis point move on a 10-year yield lower, and all of a sudden there's reason to be bullish here.
Exactly. I mean, basically.
That catches my eye. I thought this bond market had become de-anchored from all of the stuff that was anchoring it over the last 10 years or so.
Yeah, well,
and you get a 30 basis point move and it's all good again.
And everybody's like, fine, it's stable. We've seen peaks.
I mean, I'm not
for now
being snarky. I'm just catching up because I've been away for a week.
Oh, you were away.
And the world's
for 1
changed.
week, which we're going to talk about quite a bit. We're going to talk about that full block.
Payroll is just around the corner from New York. This is Bloomberg.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The labor market is becoming much more imbalanced. Labor force growth has picked up. It's a very benign story about how this is all played out. It's basically a story where the Fed really hasn't had to do that much to bring inflation down, and the Fed basically is saying, we don't think we're going to have to do much more from here.
Others saying they're done. That was the former New York Fed President Bill Dudley. Citi's Andrew Hollenhorst, base case, the Fed is done hiking. That's a change for Citi in the last couple of months. From New York City, counting you down to a payrolls report, about 44 minutes away. Here are the scores going into that on the S&P 500. We are negative by 0.08%. Yields are lower by a couple of basis points, 463.46. The dollar is weaker, the euro stronger, 106.47 on that currency pair. And the data in our survey, median estimate, Tom, 180,000 for payrolls a little bit later.
And again, that $48,000 plug-in that Mike McKee talks about with Stryker's UAW, we'll have to see how Mike plays that at 8:30. John, I'm just going to say in the equity market, these are ever so slight movements. There's a little bit of a lift. Fractional lift to the tape right now. There's a little
Turn around for Apple as well, Tom. If you have a look at Apple in a pre-market, just take a look at the charts. Session highs, Tom, we're down about 2% at the moment after those numbers yesterday.
Yeah, and this is a raging debate. I believe Tom Forti's with us coming up, and he has been absolutely spectacular on Apple, so we'll have to see what he says.
9:45 Eastern time.
He's at 9:45.
Yes, yeah.
On the, was this the Open? I can't
On
keep
Bloomberg
track of
TV,
which
the Open, with Jonathan Farrow.
Okay, it's very good. 40 with Jonathan Farrow
myself.
would be a
Does
good
that work?
thing.
We can make that happen.
No, it's good. We'll simulcast it or whatever. It'll be good. Forti's been dead on here, looking at a number, frankly, lower than this 170 level. It was Fed Day. John wasn't with us. Lisa and I were on the desk, and Bill Dudley came on, and I read the Dudley essay.
You can tell that I've been off sick. You know, at times I
you were
sound like a
sick?
character in a Guy Ritchie movie sometimes this morning.
I didn't know who's Guy Ritchie.
Voice is just...
Anyways,
so
Bill
glad to have
Dudley's
it
on.
back.
And
Doesn't care.
Can we continue? Thank you.
Please.
Bill Dudley has a scathing essay out on the move to a soft landing and a dovish tilt. And all I said was we need to talk to Anna Wong. She's a chief U.S. economist for Bloomberg Economics, and no one looked at the magnitude of the move to higher interest rates. No one like Dr. Wong. And I thought of you with Bill Dudley, and you know, I don't want you to say that this is what's going to happen, but Bill Dudley worries about being terribly wrong if we pause or cut rates. Can we screw this up that bad? Do you agree with Dr. Dudley of the New York Fed that we could get this terribly wrong?
Yeah, I agree with Bill. So when the 10-year was surging a couple of weeks ago, I did put out a piece that says that if the Fed is acting more like a risk manager, then they got to be thinking about whether they're confident that this surge in 10-year yields is going to sustain. Because whether a substitute for needing to hike more depends very much on whether they believe this increase in surge in 10-year yields would be sustained. And, you know, just when Powell was speaking a couple of days ago, this 10-year fell. So I think what that means is that if they are acting more like a risk manager, they probably should be doing more hikes. And then if indeed inflation does not increase again and does fall, then they can just cut more sharply. So that would be what a really cautious central bank would be doing rather than pausing preemptively.
As you know, the financial media is on the y-axis. We're looking at the drama of cuts and, you know, accommodation and restrictiveness and all that. There's the x-axis. And Anna, take us out to the June 12th meeting of next year. I mean, is that what's going to solve this for everybody, is just start looking for truly a longer period at these levels?
Well, June 12th next year. Wow, Tom. So it depends on, I think the swing factor right now is the labor market. And I think that the jobs market is actually weaker than what many economists are saying. Today, we're looking for a rise in unemployment rate. It may not happen today, but honestly, I mean, but it will happen in the next 2 months in our judgment. So I think we're close to that non-linear jump-off point in unemployment rate, where thereafter it will keep going. So by June of next year, we may have an unemployment rate that's higher than the Fed's forecast of 4.1%. And in that case, the Fed would be cutting. But then again, recessions usually are not, it definitely will put a damper on inflation, but you cannot count on recessions for doing also all the work. So If by that time we have a broadening Middle East war and oil price increase, then you will be facing a stagflationary economy.
Which we hope we don't see. But Anna, when you talk about the potential job losses, the non-linear jump up in the unemployment rate, where in particular in the labor market do you think those cuts are going to be felt most strongly?
Manufacturing. So in the academic literature, people have found that even though manufacturing sector accounts for but a very small portion of GDP, less than 30% of GDP, the layoffs and the cyclical dynamics actually drives business cycles. And we are already seeing in this week's ISM report, what really shifted in this ISM manufacturing report we saw this week was that people are talking about using layoffs as a headcount management, whereas in the past, the comments were more like using attrition as a headcount management strategy. So I think that once again, just like in other recessions in the past 50 years, it would be manufacturing jobs that will lead the way to layoffs.
If we can just get a sense of where we're going back to, we saw Immerse report earnings this morning talking about cutting jobs because of a decline in some of the expected trade that they were operating within. Are we seeing a return to normal? Are we seeing something more with respect to the manufacturing sector that was really boosted during the pandemic, but now has been in recession for quite a while?
Yeah, you're right, Lisa. The manufacturing sector has been suffering for almost 2 years. In the first year, last year, most of it was due to the pullback of consumers away from spending on goods. That's pandemic driven. But this year, I think the story is different. Right now, we're seeing potentially recessions in Europe and in Canada, and China is slowing. So all these manufacturing powerhouses like Germany and China in the world are slowing. So there seems to be a second leg to this downturn for manufacturers. And this one is truly a reflection of demand destruction caused by central bank rate hikes rather than a pandemic adjustment.
I look at this, Anna, and just very quickly here as we get to this report. Are we a fully employed America?
We are certainly very fully employed, Tom Keene.
Anna, thank you so much. Anna Wong there.
Are we wrapping things up
I
there?
think we're wrapping things up
right.
there. Yeah.
Anna Wong, Bloomberg Economics.
I can't say
Sounds like
enough.
more to
I can't say enough about the magnitude of her call.
Keep it together, Bramo.
I'm keeping
come
it
on,
together.
out of respect for payrolls, I've put a suit jacket.
Oh, yeah.
on.
Good.
That's good.
I've been
Nice.
having respect
I didn't
the
know.
whole morning.
Very tonsorial.
Smart
Very
enough.
good. Yeah, great.
Yeah,
It's too slim
he's
fit.
back.
Got to take the stuff out of pockets.
He's gonna get
Put on some weight when I was
a bow
away.
tie next.
It's one thing to make a call, but to be as lonely as Anna Wong was with Bill Dudley, Mohammed El-Arian, and others, I can't convey how alone they were when they said, forget it, rates are moving up. I mean,
and now she's one of the ones saying that we don't see the labor market weakness that's going to happen, and the fact that the nonlinear jump up in unemployment, which typically happens during a recession, is still in the wings. And to me, that's sort of the unknown hovering over markets. Is that good news at that point?
Exactly. Fed is done. Good news by stocks.
Right, but this is exactly it.
It matters why the Fed might be done. And it matters what happens with the economic data. And I know you don't want to talk about the soft points in the Apple earnings report, but
they were there.
Weakness in China.
Well, the China thing's a big deal.
The Mess news out of Europe today on shipping is pretty pronounced.
Even the raging bulls of Apple, Dan Ives, over at Loop Ventures as well, they're talking about China as a real challenge. David Rosenberg in Toronto publishing moments ago, and he says productivity, John, for these markets, not for the Fed, not for the ecobabble we're talking about, but David Rosenberg says productivity is a thing of beauty for the markets that we saw yesterday, and that's added to the surge that we
And you want to see a whole lot more of that. We'll catch up with Nadia Lovell of UBS on the equity market in about 5 minutes from now. Then it is the countdown to the payrolls report, 35 minutes away. And these are the numbers we're looking for, 180K, 180,000 is the median estimate in our survey. Unemployment, looking for that to come in at 3.8%, in line with the previous month's read. The job data just around the corner. Equities coming back about 0.1% on the S&P 500. Yields lower on a 10-year by a couple of basis points. Your yield this morning, 463.67. From New York City, this is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Sort of not out of the woods yet.
It really feels like right now we're in a transition period.
For a lot of people, the soft landing narrative is still in place.
As long as we get the economy right, I don't think we're going to have a recession next year.
Everybody wants to know who's going to ring the bell when it says, is it soft landing or is it a recession?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Jonathan Farrow and Lisa Abramowitz, they're in today. It's Jobs Day in America. Decided to show up. Nadia Lovell to join us here in a moment. And it's a Jobs Day, and I'm sorry, there's many, many mysteries out there. And John, I mean, do we go up another, 200 Dow points here off of the jobs report?
Oh, you were trying to wind me up, aren't you?
Yeah.
Let's start with payrolls. The estimate for the number that drops in about 30 minutes' time, 180,000. The previous number, a blowout 336. So far, so good for the bond market bulls. And, by the way, for the equity market bulls as well this week. We've had everything we wanted, haven't we? Treasury refunding wasn't too bad. right?
It was
Look at the
very
data.
good, and I missed
The
that.
ISM came in
Grandma nailed
soft.
that.
Chairman Powell didn't disrupt things. Will you get a clean sweep when you get payrolls in 30 minutes' time?
I think you also get a little bit of revenue number here. I mean, the earnings are coming in. There's different opinions I'm seeing on down the income statement, what's going on. But as a general statement, nominal GDP third quarter was a blowout statistic, and that sort of helped corporations amend and adapt here. You missed it, but Ellen Zentner last week, her decline in real GDP, John, in the fourth quarter gets you to a jobs report of 50,000. We're not there yet.
That's an easy call.
We're not going to see that.
It's an easy call to sit here and say the third quarter as good as it gets. From here,
Yeah, thank you.
slower.
They do okay?
It's how much slower from here. It's whether the global economy is going to be held up by who? By Europe right now? I don't think so.
Yeah.
By China? Real struggle. Look at the Apple numbers that we had out. iPhone sales in China, real difficulty over there.
So,
Moller-Maersk, AP Moller-Maersk, the latest numbers out of the shipping company over in Europe, Tom.
So,
Real
Lisa,
struggle for
what's
them
that
as well.
fold over to in terms of not maybe even this jobs report, but the jobs report before the December Fed meeting?
I think if you put this together, there's a question of what does Goldilocks look like? And John, you've been on top of this. But this idea of when is it not good news anymore? When do we have a sense of a non-linear increase in unemployment at a time when you do see this kind of headline with Maersk cutting at least 10,000 jobs globally, when you do see the potential for further cuts within manufacturing, when you do see people working longer work weeks in a sign that they need to finance the grocery bill that's gone up dramatically over the past 2 years?
Let's review that because, John, this is important. And this was a headline that we saw talking about cumulative monetary policy and Lau Brainerd and all that. Lisa and I did a study of cumulative grocery inflation, up 3.5, then up 3.5, then up 11. And I did a compound, took the HP12C out. Groceries are up 19%, according to USDA, over the last 3 years. That's part of this jobs report today.
We can sit here at 8:30 and tell everyone how things look good. Unemployment's got a 3 handle. Let's see if it still does in about 27 minutes. Tom, we can sit here and say all of those things.
Right.
So many people in this country don't feel it. You go and look at the consumer confidence surveys. It doesn't show up in the way that this administration, this White House would like it to. Whether that changes between now and next November is a very important question for the president.
And it goes again to what we're going to hear from the Department of Labor later today. They're going to have to spin whatever statistic we see. And after the boom, the shock number that we saw, and again, you got to adjust here, folks. Lisa, you got to adjust by 48,000, according to Michael McKee on UAW.
Because of the strikes. And this is, again, the vagaries, the uncertainties of just how fungible some of these numbers are. The fact that these strikes happened, it seems like people are coalescing around the idea this was the last gasp ahead of the last opportunity to really rally behind this.
The real yield down 2 basis points, 2.25%. John, I'm sorry, yields smashed lower even in the inflation-adjusted world.
Down 20 basis points on a week. It's been a big move in the Treasury market, big move in the equity market too. The stock market poised for its biggest weekly gain of the year so far. On the S&P 500, we're negative by 0.1% on futures this morning. In the equity market through Thursday, the S&P up by something like 4.9%. The NASDAQ 100 TK this week up by more than 5% Monday through Thursday. We've been higher every single day this week in the equity market.
Nadia Lovell nailed that. She's senior U.S. equity strategist, UBS Global Wealth Management, and joins us this morning on equities. Nadia, what I've seen, and this is off the October low, and then there's been this churn, breakout, no, breakout, no, breakout, no. Can you signal the way we've gone up this week to be the form of up where you do get an equity surge to a new level?
Yes, I mean, Tom, as we've been saying, we thought that this dip is viable, and we still think that there's more upside to the market from here. And so we expect the market to continue to rally into year end. We do still think that, sentiment is still too bearish. When you look at the AI bear indicators at the highest level it has been for this year, you also have positioning that's still light. And as you noted earlier, the earnings season is coming in better than expected. And so we think that the outlook continues to improve. You also have seasonality. We know that historically when you've had a strong January to October, that acts like a tailwind to the market as well.
How much in this does the 2-year yield have to come in as a cash proxy? I'm folding it into Fed speak. But how much do we have to go from a 5% level on, say, a 2-year to a lower yield to really signal where equities compete with cash?
I think you have to see the 2-year come in, probably down to like a four handle, for it to make it seem like equities is more attractive. But remember, like, we don't think that the higher bond yields, particularly in the low end of the curve, we know isn't sustainable, because once the Fed starts to cut, those will start to come down. And so longer term, you do want to move out in duration, and also longer term, you do want to maintain that exposure to equities, because you don't want to stay on the short end for too long, given the fact that the Fed is likely done hiking and we'd be in a position to cut next year.
We're in a sort of awkward position today, Nadia, where a lower than expected job creation number will lead to a rally, most likely in stocks, as long as it's not too low. What is that too low point where bad news is bad news for risk assets?
I think if you get a job numbers that's under 100,000, that will probably signal that the economy is slowing much faster than anyone had expected. I mean, coming off of the momentum of the third quarter, we are looking for a slower growth, but we're not looking for a recession. We're looking for GDP to sort of slow down to the 1.5% range over the next couple of quarters. But if you have a job market that rolls over too quickly, then there's concerns about consumer spending, and it probably puts the Fed in a tough position and probably has to start cutting sooner than expected to.
You said something, Nadia, when building on that point of the Fed having to cut sooner than expected. How much is your bullish view and those of others who are in the equity markets predicated on this idea that the bar to cut, as John was talking about earlier, the bar to cut rates is actually lower than it used to be, based on what we heard from Jay Powell this week?
I don't necessarily think that the bar is lower than it used to be. We've always maintained the view that if the job market starts to roll over, that the Fed is going to be quick to respond to that. The Fed continues to try to thread this needle to avoid a recession. And so we do expect that now that the Fed has said that the risk is balanced, that they will be quick to respond to any sort of weakness in the job market. But I think the job market will have to get close to turn into negative payrolls before the Fed responds. That's always sort of been our view. So we don't think that that's changed.
Right. Nadia, how do you measure growthiness right now? Everybody's looking at Apple. John Farrell will have Tom Forte with him at 9:45 here, who's really cautious on the growthiness of Apple. But how do you, as a broad strategy, measure how a company's growing?
For us, top line is important, and then maintaining margins and having margins that are expanded to help drive that sort of bottom line growth is important as well. I mean, I would say in terms of, it's not too surprising to see, like, the leader in smartphones see some softness, particularly overseas, just given the headwinds that they've also been facing from a regulatory standpoint. But when we look at the broader tech complex, we do think that the outlook has improved, even though we do remain, neutral on the sector. We do think that there are pockets of opportunities. And when you look at throughout the earnings season, I would say, Tom, within tech, it's actually been pretty encouraging. You're seeing some stabilization in IT spending. You're seeing a pickup in AI-related revenues. And even within semis, I think that you're starting to see some of those areas bottom out, particularly in PCs as well as servers. You are seeing the analog areas sort of roll over, so we're a bit more cautious on that. And so we do think that the growth complex still remains intact, even though you might have some outliers in some of the larger names, like particularly in the smartphone and hardware area.
We've seen this incredible rally in big tech so far this year, and big tech was one industries that publicly announced a whole host of job cuts last year. Going forward, in other industries, do you think that announcements of job cuts will be good news or bad news in terms of a signal to go buy them?
I think in terms of additional cuts in the broader economy, we know that tech and some parts of finance had excesses coming out of the pandemic. And so I do think that the market will become cautious if you see more wider range cuts in other sectors, because it would signal that the economy might be slowing down. So not necessarily would jump in, 2 feet into these areas if you start to see weakness in terms of cuts. But at the end of the day, if companies start to cut aggressively, it's probably an indication that top line is softening and they're cutting headcounts to be able to, preserve margins. And so I don't necessarily think that that is a positive indication. because it's unlikely to be excesses, and it more has to be due with top line, protected in top line.
Is that the next phase? Nadia, thank you. As always, Nadia Lovell there of UBS Global Wealth Management. Nadia's views and UBS's views on the equity market going into the opening bell about an hour and 20 minutes away. Before we get there, we need to deal with the payrolls report, Tom. 180,000 is the estimate in our survey.
It's going to be fascinating. I don't have any. So people email me. They go, "Do you want to be in our pool about like guessing like what the number's going to be?"
And you say
it's an uproar.
Did you have money on Man U?
No, yeah, I did. Okay. But Bramo, well, she nailed it. You should have heard the two of us doing John Farrell's soccer talk.
Did Bramo watch the game?
It was thousands turned the channel.
We don't want to talk about that.
Thousands.
You know what? I despise the fact that you make this about me. That you call it John Farrow Soccer Talk, because this is you're responsible for this, not me. You are responsible for this.
Big game this weekend, Newcastle, Arsenal. Okay. And it's not a derby, like they're far apart, right?
Geographically, yeah.
I nailed that, folks. Thank you. But this is pretty cool. I mean, these are two really invigorated teams.
I'm excited for the F1
below
this
the
weekend.
tots, but you know.
Sao Paulo, Brazilian Grand Prix this week.
How was that?
Very cool.
But you watched soccer down there, you know.
I did 2 weeks ago, yeah.
Yeah, very
I watched the local
cool.
derby, Palmeiras, Sao Paulo.
Why is Brazil F1 a big deal? Is it like on a big ugly track like Austin, or is it like
it's
roads?
One of those old school tracks, very cool, lots of history.
Old school track.
Yeah. It's going to be great. Look out for that, Tom, this Sunday.
Okay.
That's your sports wrap. If you're just joining us, we're back on track apparently. Welcome to the programme. We're negative by 0.01%. Payrolls just around the corner. Tom, to watch the game in Brazil was fantastic, you know. Brilliant. Young lad there, playing for Palmeiras, Endrick, teenager, I think turns 18 next year. He's already been purchased by Real Madrid. So he's going to complete the season there, and once he turns 18, he's going to go over to Madrid. Okay, fantastic football player.
Is it Rick Carlson for the Tots?
For the Tots, yeah.
Why is he struggling? He was like giant in Brazil,
No,
right?
he's just not as good.
He's not as good.
Do you know what was interesting about going to the game?
See how he gets going, Lisa.
Facial recognition. Facial recognition to get into the game, yeah.
Well, that makes sense to prevent
So
violence.
you turn up, no away fans. You turn up to the game.
Interesting.
Scan your face. Walk in.
There's a reason for this.
John, for the 2000
violence.
John, for the 2000. John doesn't know this, folks, but for the 2024 surveillance budget, we're going to have facial recognition.
Are we?
For our guests
to get into the studio.
To get into the
Can
studio.
I just say, I'm getting trolled by some of my emails. So one of them, Arsenal is the most expensive Premier League club for football supporters. Chelsea, Tottenham, and Liverpool are among the others. More
Is
expensive.
that one of those PR emails?
Yeah, but like people are targeting me now with them.
I love
Thanks
that you
to
open
guys.
that stuff up.
I do.
we want to see is a little bit more slowing in the labor market in order to see more slowing in those components of inflation. Because if we look at the ECI, it does look like wage gains are still a little too brisk to be consistent with sustainable 2% inflation.
We will get another read on inflation, on wage growth in about 15 minutes' time. That was Jonathan Pingle, the chief US economist over at UBS, going into the payrolls report. That payrolls report just around the corner. Here are the scores in the financial markets. The price action looks like this. On the S&P 500, we're negative 0.07% on the S&P. Yields are lower by 2 or 3 basis points on a 10-year, 463.25, backing away from those cycle highs of a couple of weeks ago, through 5% for a heartbeat on a 10-year, then all the way back down again, Tom. Lower by almost 40 basis points now in the last couple of weeks. We're down 20 this week alone.
A changed world in the last week, and again, we're watching equity markets, and I'm going to call it there's a constructive bid to the tape after the festivities we've seen over the last number of days. If you come out of the University of North Dakota, you're an engineer, and somebody says, hey, do you want to write a microeconomics textbook with Austin Goolsbee and Freakonomics Steve Levitt? You say, yes, sir, I'd like to do that. Randall Krosner knows who I'm talking about. It's Chad Syverson, who's expert on productivity in America. Syverson is at the Chicago Booth School, and joining us now, the former governor of the Federal Reserve System, Randall Krosner. Randy, you go in and you have a cup of coffee with Chad Syverson this morning on this mystery called productivity. Has it really changed? Do we grossly underestimate on this jobs day the productivity of America?
It's one of the key things is trying to get the measurements right. And when you're in an unusual situation like we've been in over the last few years, there's a lot of questions about whether we're measuring the number of hours correctly, because of course so many people are working at home. And as we move more and more into services, it becomes harder and harder to measure productivity. It was easy when you're just like churning out particular pieces of machinery. You can see it takes 4 people to churn out 2 machines a day. But when you're providing services, it's a little bit more difficult to get those measures right. But I think we are in a pretty good position with respect to productivity these days.
I mean, the chart that I had earlier, Randy Krosner, we don't need to show the chart now for radio, it's too much stress, but the idea, Randy Krosner, of age 25 to 54, that COVID rebound is spectacular. Was that all because of stimulus?
I don't think it was just because of stimulus. I think some of it was coming back naturally because, of course, you had lower labor force participation after COVID. People were pretty worried about their health situation of going back into work. But now we have more flexible situations, still a lot of people working from home. That's allowed more people to come back into the market, job market comfortably. And so basically, we're fully back in terms of labor force participation, except for older workers. And that makes sense because they're the ones who are probably the most wary of coming back into the office. And even if they don't have to come back to the office, they said, you know, we've seen too many people not make it through. I want to spend time with my kids, grandkids, and so I'm not coming back in.
We are seeing, though, the work week starting to lengthen a little bit. People are working longer in order to make ends meet, especially given grocery bills and everything else going up as much as they have. And this morning we saw Maersk put out an announcement, the shipping company, saying that they plan to cut at least 10,000 jobs in response to declines in demand across the world. How much is this a sort of foretell for what's going to happen in the next couple of months, particularly with manufacturing jobs?
Yeah, as you know, as I think I've mentioned here before, my view is, you know, people have talked about a hard landing, soft landing. Jay Powell talked about a softish landing. I'm talking about a hardish landing. I really don't see how the economy can continue on in this way with astonishingly strong job growth and really get inflation sustainably down to 2%. I do think that it's likely that we're going to see some softening in the labor market over time, maybe not this month, but certainly over time. And I think that's one of the key ways in which you'll get less wage pressure, less overall price pressure, and getting back to the 2% target.
What surveys are you looking at? I know that holiday hiring isn't necessarily as big as some people were expecting, according to some initial views. What tea leaves are you tracking to understand that, yes, a hardish type landing is the most likely scenario with some sort of jobless rate increasing at a nonlinear fashion?
Yeah. Let's look at to go too far of make sure we have a distinction between hard and hard-ish, because I don't think we're going to be going off the cliff. But I do think it's likely that we'll get the unemployment rate above 4% relatively soon, and probably to the mid fours. And so I think you can see there are somewhat fewer job openings. You can see more and more concerns about that firms are discussing. You also see that workers feel a little bit less confident. You're seeing a lot less quitting than you had from before. That's getting back to sort of a more normal labor market situation. And in a more normal labor market situation, we're probably going to see a bit of an increase in unemployment before we get wage growth to really come down to what will be a sustainable level consistent with a 2% inflation target.
It seems like Fed Chair Powell is on the same page with you, equally concerned about greater weakness than expected, in addition to the inflation backdrop. Do you think that the Fed will be more willing to cut rates more aggressively next year if what you expect to happen comes to pass?
So I think they're going to hang tough, and hang tougher than most people expect, because over the last 20 years or so, the Fed has always been there to provide a cushion against a downturn. Now they know that they may need to take that risk of a softening labor market and even potentially a mild recession in order to get to their inflation goal. And they've made it clear that the 2% inflation target is what they're sticking to. That is their goal. And if it means that the unemployment rate may rise a little bit more than they expect, I think they're going to hang tough on that.
Professor Krasner, I'm going to treat you like a market economist. Where's the tip point on the unemployment rate in your head for when you say we're moving beyond full employment or the glory that we're in right now? Is it 3.9 to 4? Is it 4.5, or is it a statistic higher?
So I'd say in the environment that we're in, it's sort of low fours. It's really been quite astonishing to see the unemployment rate below 4% for so long, particularly as labor force participation has come back. So I think it's likely that we'll move a little bit above that to the upper fours, or maybe even into the fives. Now, of course, that's not the best for the labor market, but boy, compared to past slowdowns, that's still pretty darn good.
I looked at Topeka, Kansas. I think it's 2.9% as a statistic right now. And there's a nice, pretty chart from, I think it's St. Louis Fed, which shows it used to be 3.5%, 4%. Do we have to almost R-starred set our unemployment rate lower over what is normal?
Well, that's one of the things that's being debated now, along with the neutral rate, the so-called R-star. Has that fundamentally changed? Most people think that during the slowdown times that we've had over the last pre-pandemic, and into the beginning of the pandemic, that neutral rate was much lower. A lot of discussion about the unemployment rate. Now people think the neutral rate is higher. And then the question is, what is the benchmark rate for the unemployment rate? I don't think it has moved down as much as people think that it might have to the threes, but it's one where it's really difficult to estimate in real time. And it used to be something that was seen as fairly constant, and now it's something that moves around a fair amount in our estimates, just like that neutral rate.
Hey, Randy, stay close. We need to catch up with you again in just a moment. If you are just joining us 5 minutes away from the payrolls report in America, Mike McKee joined us now to give you a little bit of a preview. Mike McKee, I'll do the basic stuff. The estimate, 180,000. I know you're focused on way more than just that.
Yeah, we'll be looking at the unemployment rate because, of course, the Fed has tipped that as one of the key measures they're following to see if the economy is slowing. 3.8%. It had gone up from 3.5, so a significant move a couple of months ago, and then it's locked in at 3.8. Does it go up to their 4.1? That'll be a key question. And, of course, the Fed, everybody else wants to know what's happening with average hourly wages. Right now, we're at a 4.2% annual rate. Does that slip down a little bit more and give them some relief on the wage front? One thing we want to mention, John, and I know I told you guys about it earlier, is the strike situation. 48,000 workers off the job, 30,000 of those or so from the UAW during October. So mentally add in to that 180, and you're looking at about 221 or so, 228. So keep an eye on that as an explanation if the number comes in a little low.
If we do talk about data dependency, and as people were saying earlier this morning, that this still is a data-dependent Fed, if they are Are we looking at continued acceleration, or are you seeing the signs of that would give you pause, the deceleration signs that we heard from Anna Wong and from Randy Krosner?
You can make a list of all the indicators, Lisa, and you come out about half and half. Some of them are suggesting things are going to go at about the same pace, and others are suggesting a slowdown. Now, you would expect a slowdown. That's what's supposed to be happening. And we used to be worried about whether we would slow too fast. Now we just seem to be worried about whether we slow at all. So going to be interesting to see now, as you mentioned, data-dependent Fed, but we have a lot of indicators, another employment report even before the next Fed meeting. So this one won't carry a whole lot of weight other than in the markets.
Michael, what's the geographic and demographic distribution of our fully employed America? I've been mentioning Topeka, Kansas. I picked them out because I watched The Wizard of Oz last week with Afterthought. But, you know, help me here, Michael. How geographically distributed is this, or is it more homogenous than we think?
It's been generally pretty homogenous, which is kind of interesting. We haven't seen a lot of migration, and of course that's a topic for economists like our friend Randy Krosner. What's happened to the idea that Americans pick up and move, the Dust Bowl movement to California kind of thing? People are much more tied to their communities, and we've seen the effects of the offshoring, the move to China, sort of play out now. And now you're in a situation where people aren't moving as much and jobs aren't moving as much. What's interesting is that this new infrastructure spending that the Biden administration is doing, they're awarding contracts to areas where unemployment is relatively high and people have lost jobs, and trying to even things out. We'll see how that works out.
Mike, you know how this gets filtered on Wall Street when the data drops in about 2 minutes' time. You look at the data, you ask a simple question, what does it mean for Chairman Powell? Then you trade accordingly. Mike, how relevant is this information for the Fed chair, for this committee, a little bit later?
It's not particularly relevant. It'll be relevant on Wall Street for the reason you suggest about the question that they're going to ask, but we're going to see rates move around a lot between now and the time the Fed meets again on December 13th. We've got inflation reports, jobs reports, spending reports, so they're not going to pay a whole lot of attention to what's going on Wall Street until they get closer to the time, of course, barring any kind of collapse on Wall Street. But until we get much closer to December, they're going to be sort of on the sidelines watching film, as the football coaches would say.
Mike McKee, stay close. Thank you, buddy, as always. They take note of the tightening of financial conditions, and Bramo, right up cue. The financial conditions are less tight.
Exactly, which is the reason why they said, you know, it has to be a sustained move. You do wonder whether they're getting a little bit concerned about the whipsaw action in the wrong direction, easing financial conditions.
I've been remiss. I didn't mention this. I'm sorry. Maybe in months and months and months, the revisions here, John, are a huge deal. I'm still not used to a 336 number here last month. I'm fascinated how that gets revised.
I really missed you over the last week. Got emotional. You called me a lot as well.
Okay, can you get me the Kleenex,
called me
please?
a ton. You're sounding better. When are you coming back?
Yeah,
just admit it. That's what you said. That's what you said yesterday. It was emotional. Good. If you are just joining us, it's been very emotional.
I'm in therapy with
over
HR.
The last. How's therapy going?
Oh, with HR, it's going great.
It's going awesome. It's going awesome. Payrolls, just seconds away. Here are the numbers we're looking for. 180K is the estimate in our median survey. In our survey, that is the median estimate, 180. 336 is the previous number. For unemployment, 3.8%. That is the estimate. The previous number also, 3.8%. Going into these numbers, equity slightly negative on the session, but up big time on the week. On the S&P 500, we're negative right now by about 0.1%. Yields are lower by 6 basis points. The job numbers drop. Mike McKee's got them. Hey, Mike.
John, they come in a little bit weaker than anticipated, 150,000 for the month of October in terms of jobs created. Now, remember, you got to add in those 48,000 strikers, so we're looking at basically 198 here. Change in the unemployment rate, we go up to 3.9%. That's a tick closer to where the Fed thinks that they might want to be. Tom was talking about the revisions to prior months. The September number revised down from 336 $2.96 to $2.97, so a significant change there as well. Average hourly earnings up 0.2 as forecast, which drops the year-over-year number to 4.1%. So in all of these numbers, we're kind of moving in the way the Fed wants to see it. Net revisions down 101,000 when you add in August as well. Labor force participation rate ticks down a little bit to 62.7. The U6 rate, 7.2%, that's a little bit higher. So we'll see how the markets are kind of reacting here. I might mention loss of 35,000 jobs in manufacturing, and we saw that weak ISM number earlier this week, so maybe that is what is playing out.
Mike McKee, take a guess. It's a clean sweep for the bond market bulls. Yields are lower by 8 basis points at the front end, 2-year, 490. 10-year right now, 457. Yields lower on a 10-year maturity by 8 basis points. On a 30-year, down 5. So bonds rally, yields drop in the FX market. The euro pops, getting close to 107. Right now, 106.94. That currency pair positive by 0.7%. Put it all together, equities rally on the S&P 500. Futures higher by 0.4%. A clean sweep this week, Tom, for the bond market bulls. They've had everything they wanted, every single data point. The Fed speaks so far from Chairman Powell. Throw in the labor market data as well.
If you're short, if you're out, what do? You got to get in now. And what I'm going to go to, and you heard that, John, with Michael McKee's breadth of data, this wasn't about one data point indicating a softer labor market. It was 1, 2, 3, 4, even 7 of these data series indicating an ebb from that fully employed America.
It's early days, things can change. We're only 2 minutes past the number, but Lisa, it's not too hot, it's not too cold. What might you call it?
Goldilocks.
Oh,
do you really want to do that?
That was
did
painful.
hurt, because honestly, we're looking at actual weakness, particularly in that manufacturing sector. And I want to piggyback on what Anna Wong was talking about and the Maersk numbers. Is this a leading indicator of more cuts to come? It's Goldilocks until it's not. It looks like a soft landing until it's not. And that is definitely where people are going to be focused. Again, I want to see whether, yes, maybe the move in the bond market sticks, but what about in risk assets? Is it still good news when people aren't getting employed as much if it leads to something more significant?
Right. Mike McKee, I know you want a second look at this one. What do you see?
Well, you take a look at the unemployment rate, and we had a big drop in the labor force size of 201,000, which contributes to a reason we see the number go up. But the employment level in the household survey down 348,000. The level change for unemployment up 146. A lot of people like to glom onto the difference between the household and establishment surveys, and this certainly will give those people some ammunition in terms of the number of people who are unemployed or who have lost their jobs. So there will be some talk about that. The other thing that sort of stands out is that in terms of job creation, private service jobs, 110,000, but those are really distributed kind of across the curve. Healthcare workers are pretty much, as always, the leaders here. Leisure and hospitality, 19,000 jobs, so still adding some there. Where you really see some movement, construction up 23,000, and government up 51,000 for the 3rd month in a row. So maybe some of the seasonal factors that have been affecting government spending have kind of petered out. But at this point, what it looks like is a fairly evenly distributed between losses and gains, and no particular area that is that stands out. Although I do need to check, and I'll go do this right now, on auto workers.
Well, you know, we've got the data here, Mike, and I guess the question is this a 1 month, first month move, or can you take, say, 3 months annualized of any of these numbers and say, we have a vector in place to a weaker jobs market?
I don't think you can. Because manufacturing, for example, we lost 35,000 jobs, but we gained 14,000 the month before. It doesn't look like there's any one category that screams we're turning around here, that things are getting much worse. We have a number that you could keep an eye on. Manufacturing, retail only adding 1,000 jobs, those kind of things, but you're going to need a couple more months of this to discern any particular trend.
Mike, thank you, buddy. Looking forward to talking with you again in about 25 minutes' time. It's not terrible, it's not amazing, it's something in between, and the bond market likes it. Treasuries rallying here, 10-year yields down by 9 basis points, 4.57 on a 10-year, on a 2-year down 8 basis points, 4.90. Look out for Mike McKee with the Atlanta Fed President, Mr. Bostic, a little bit later on. Raphael Bostic Bostic, the Atlanta Fed president, 3:30 Eastern time. The way we always think about this, here's the data. Tell me what the Fed thinks about it. You'll find out a little bit later on this afternoon with Mike McKee. Tons of Fed speak still to come. On the open, fantastic lineup. Rick Reeder, Mike Collins, Anastasia Amoroso, Mohammed Al-Arian. All of that still to come next hour on Bloomberg TV. Tom, with a downside surprise on a payrolls report, 150, and an equity market that's at session highs, positive by 0.4%.
And puts it on here. It'll be fascinating to see how we get to your conversation with Dr. Al-Arian. Futures up 18, Dow futures up 136, and the VIX, sprightly. I can't fathom a 14 VIX. We're not there yet, but 15.35. Lisa, the bond market is extraordinary. From the peak there of just above 5% in the 10-year yield, good Bloomberg mathematics, it's a 4 standard deviation move from +2 SD down to -2. It is a complete gap move down now in the 10-year yield.
And not to be wonky, you're watching the 10-year yield, and it has been a gap move. I'm actually watching the 2-year more closely today, because the move is pretty substantial from session highs to session lows of about 10 basis points, and this feeds into the Fed's reaction function. People are viewing this as keeping the Fed on hold and possibly implying more cuts than they currently are signaling.
What you need on Jobs Day, more Newtonian calculus. We'll do that with Randall Krosner of the Booth School of Chicago, of course, the former Fed governor, one of our great and giant financial economists in America. What's a second derivative of the jobs market look like, Randy? When it moves, does it move?
And that's the key question, exactly what you were talking about. What does this portend for the trajectory going forward? Certainly, we're seeing a slowing pace over the last few months, downward revisions. And then the question is, will this be nice and smooth, or will this portend something that is going to be, as Lisa mentioned before, nonlinear? Very difficult to predict any nonlinear moves and things, but I do think it's consistent with a somewhat softening labor market. I think the Fed will certainly be heartened by the wage growth coming down a bit over time. I think this takes the wind out of the sails of those who wanted to go further. I think it makes it much more likely that we will just hold where we are for a while. But so far, there's nothing in this to suggest that the Fed is going to be eager to cut or be even talking about cutting anytime soon.
Do you think, Randy, as some people are pointing to manufacturing as a point of weakness, that is a leading indicator in the way it has been in previous times, just because of how many people were hired during the peak of the pandemic?
It is certainly one area that there was a lot of bounce back because, of course, people wanted things, but now people want services, and so the services part is still extremely important. I wouldn't put too much emphasis on any one particular sector. I think you have to look overall. And as Mike had said, we're seeing a little bit of slowdown broadly, but not an enormous amount of slowdown. But I do think this is consistent with, in some sense, where the Fed wants to go. They want to see the unemployment rate go up a little bit, not too much. They want to see wage growth come down a little bit, but not too much. And I think it's just going to be tougher to be hiring people going forward. Until just a few months ago, real wages were not growing. They were actually negative. Real wage growth was negative. Now real wage growth is positive. So that gives less of an incentive for firms to hire. Real interest rates are now positive. They had been negative for a very long time. That combination is probably going to lead firms to be less eager to hire, less eager to invest. And I think that's going to be leading to what I think is potentially a hardish, but not hard, landing.
This is an important jobs report. This November report of the October data, just absolutely extraordinary. Randy Krosner, thank you so much. Professor Krosner with the Booth School, the University of Chicago. Futures up 17, Dow futures up 139. I'm going to call it a 0.4% move. Lisa, what do you see over there? Your screen's cleaner than mine.
I'm looking at the 5-year yield as well, because that's one way to look out over rate cuts. And it's coming down quite a bit, but it's 4.5%. Also, getting some color from some viewers, so I want to thank them for this, saying that the tone has changed materially for companies looking to sell debt. That suddenly they're ready to go back to market and to lock in some costs, because just some stability and yields coming in a sense that buyers are still going to be there is enough to bring people in. There is still a tone underneath all of this, a very strong risk appetite, and a sense that really we are going to get a soft landing, and this highlights that.
My number one advisor, Marty Schenker, holding court in a cafe in Paris right now. And I said to him last night by email, I said, when does Apple do a bond offering? I just wrote it out with this market move, and now this even more on steroids.
And we're still looking at higher borrowing costs than we had in the past, but the strength of the consumer and the strength of the balance sheets, to your point, is giving people confidence even at some of these levels.
As Lisa speaks, we have the 10-year real yield with new effort lower. We've gone from 2.20 to 2.19. If you're not part of the global Wall Street gang, you've got to understand it's hard to look at the Bloomberg screen and frame it out from where we were 2 weeks ago, which gets us to Keynes, and when the facts change, I change. Jeffrey Rosenberg studied as Maynard Keynes at Carnegie Mellon. He's a BlackRock portfolio manager, systematic multi-strategy fund. For all of us, Jeff Rosenberg, are the facts changing?
Great question, Tom. The narrative is changing, and the facts are driving that. And so Lisa asked the key question, how do you rally in front of a slowing labor picture? And that's because it's where we are. Equity markets were weaker while the economy was strengthening, and that was really about the rise in the denominator, in the discount rate and the interest rates. So as you ease off the pressure in terms of the interest rates, there's a little window here where the narrative changes and there's relief because the discount rate is expected to be a bit lower, and you see it in the bond market. But that's about horizon, and so the near-term horizon narrative will shift, but the longer-term horizon about that hardish landing that Randy just mentioned, that'll be, for future conversations. Right now, the market's pretty excited about lower discount rates.
Jeff Rosenberg, people would say BlackRock is part of that wall of money that's out there. Okay, we got a short cover here, a short cover there. I got futures up 18. Rosenberg knows the numbers better than me. Are we underestimating, Jeff Rosenberg, how many people here are off sides and need to get in and play now?
Yeah, we talked about this after the FOMC. The near-term volatility is all about technicals and positioning, and so you're going to have that, and you're going to see those moves. The longer-term positioning is going to be about trajectory and fundamentals. But certainly, after a report that pretty much convincingly across the board, as you highlighted earlier, this is a report that helps to support the narrative of slowing in the labor markets, slowing in wage inflation, even though that's a mixed shift probably in the AHE number. But across the board, especially with the revisions, it just looks like this is coming in slower. And so that helps to feed the near-term narrative that you get to the soft landing. As Randy said, whether it's soft landing or hardish landing or hard landing will remain to be seen.
When do you go with groupthink and when do you push back, right? I mean, when do you go with the crowd if sentiment is shifting and you're seeing people go into risk, if you believe that essentially bad news will be bad news for risk assets?
Yeah, it's a lot about kind of looking at what's in the price and how much cushion you have against the consensus move and where the asymmetries lie. So I think right now the momentum and the sentiment around soft landing is going to be pretty hard to push back against. But as we see successive waves of data, we got a couple more here in terms of before we get to the December FOMC, there's going to be a little bit of momentum here around the easing off of financial conditions, the easing off of tightening from the Fed. And I think that's going to provide a little bit of a tailwind for a short horizon trade.
And definitely the momentum tends to overshoot. And there is this feeling that this does set the market up for more fragility heading into a print that could be a big surprise on the downside. Jeff, how much is that sort of the play right now, is to lean into the momentum, go with the flow, soft landing. Sure, you can celebrate, but the music will stop eventually. And each one of these economic prints are going to have that much more heft and importance in markets.
Yeah, and the main issue here is really about long and variable lags. And Tom, I know you hate every time I say that, but it is, where do you see that pressure coming in? Randy talked about the pressure in terms of easing off of hiring because real wages are no longer negative; it's more expensive. You talked about funding costs, and maybe there's a little bit of an opening up in terms of the bond market. But I don't think I think you got to remember here, these are much more expensive funding costs. And so
Right.
if you don't have to issue that debt because you've termed it out, you don't want to issue that debt. And so even though the market may be open, it's at a much higher cost, and that lagged effect of tightening in terms of interest expense is something, the market is still going to have to figure out where are the vulnerabilities. And there are vulnerabilities to that impact.
On Bloomberg Television and Radio, Jeffrey Rosenberg with us with BlackRock, really timely. And of course, we thank him for his Fed work as well. He's going to stay with us right now. I can't do a complete data check because Jeff Rosenberg is too important. But Lisa, there's some real nuances here. Futures up 19, continue to advance. Dow futures up 139. Can I get to a VIX of 14? I'm not there yet, 15.26. As Bramwell mentioned, folks, a 2-year yield in 13 basis points. We continue to see lower yields and higher prices. 10-year in a stunning 11 basis points. And just, outside the box here, I got weaker dollar. I got euros through 107. I've got yen dynamics. But euro yen, what does the Japanese institutions do this weekend off what Jeff Rosenberg says? Because I got euro yen 160.01. If they're not going to act now, Lisa, when are they going to act?
That does raise a good question. And Jeff, to that point, does the move that we're seeing in the U.S., a sigh of relief, open up possible monetary disruption elsewhere? Hint, hint, Bank of Japan, that could be disruptive on the other side.
Yeah, I mean, that's a big global story and one we've been talking about for a while, waiting for. We got a little bit of it in terms of changing the definition of yield curve control. And there's an expectation that there's going to be more. And there's an incredible amount of fiscal stimulus coming out of Japan that is really going to push the BOJ even further. And so that's been a global impact. It's dampening term premium. It's part of the term premium steepening story. The refunding, certainly has pushed back on that and positioning, a bit offsides for that somewhat surprise refunding. But really the big story there is going to be global term premium steepening. And that's, I think, long-term going to come back to the U.S. But near-term, this is going to be about softish landing and slowing of the Fed, and the market's going to run with that.
We're looking right now at 2-year yields just tanking. I mean, honestly, this is quite a move, 15 basis points nearly from top to bottom in this trading session as people parse through this. Jeff, just want to finish up with the Fed's reaction function, this concept of what it takes for the Federal Reserve to cut rates. Right now, there is baked into the markets in real time a sense that they will be cutting rates in much sooner than they're saying. Do you think that's accurate, that the bar to cut rates has somehow come in as a result of just the general feeling in the public and the lack of willingness to tolerate much higher unemployment rates?
Well, it's tricky, Lisa. I mean, I think the reaction you're getting right now, pricing out the kind of probabilities, the limited probabilities of the last hike, right? So, you go back to Wednesday and, you remember the question and, he talked about we're not even, talking about cutting rate. Now, obviously, the market is because the market is looking forward here. I think you got to see a lot more development on the inflation side before you get there. And then the other problem we're going to talk about, I think, is the reflexivity. I think you mentioned it, is that, the Fed could do less because the market's doing more, but the more the market does more in terms of easing financial conditions, the more then the Fed has to do. So you kind of get yourself chasing your own tail around that story in terms of whether they can cut. So it'll come back to, does the inflation really fall fast enough to that 2% level that gets real interest rates high enough that gets them concerned that they're too tight where they really need to deliver those cuts? And that, I think, is still way out into the future.
I mean, Lisa, where do you get a show where Jeff Rosenberg channels George Soros on reflexivity? I mean, there's nowhere else in the world you can have this much fun. Jeffrey Rosenberg, thank you so much for joining us this morning. To get you to the weekend on the jobs report, and again, a great 9 o'clock hour coming up on television and radio is well. On the 30-year bond, as we showed on TV right now, these are ginormous moves as well. Lisa, before we get to IRA Jersey, give me your one fixed income data point you see right now?
I just keep watching the 2-year yield. It's not complicated.
Look
And I
at the
keep
real
thinking
yield.
about Stan Druckenmiller and how he came out and said that he was going heavily in a leveraged way, a massive leveraged bet on
this is
2-year
brilliant.
yields. And he was talking about that a couple of days ago.
Right.
How many others had massive leveraged bets on the 2-year yields that are coming to the fore
You
today?
set up perfectly where I wanted to go with Ira Jersey. Folks, this is how twisted Ira Jersey is in his memorization of Frank Fabozzi's tones. Ira has named his kids after the Greek letters, Alpha, Beta, and of course the third Jersey is named Gamma, Gamma Jersey. Ira Jersey, I'm sorry, Gamma's in play here right now. The other word we would use is convexity. Bramo nails it with the leverage bet that's out there. What's the character of the short cover, if you will, in the fixed income space?
Well, if you're going to have a levered long, like Tom, like you said that Mr. Druckenmiller seems to have put on, you have to have a lot of conviction because the carry in that trade is negative. So if you buy a 2-year note or you receive in 2-year swap rates, the short-term rate, the overnight rate, is much higher than the yield on that treasury or in that swap. So you had to have high conviction.
Right.
You know, it's working out really well now. The question is, how much further can this go if the Fed is going to be on hold for a very long period of time? And I agree with what Jeffrey said. I think the market reaction in the front end right now is firstly taking out the possibility of hikes, and then secondly pricing in for a little bit deeper cuts further out.
Ira, Lisa this weekend, open housing across the Upper East Side, looking for something with 2 wood-burning fireplaces. When you see this yield move, can you say we reached highs in the 30-year mortgage?
Yeah, it's very possible. You know, I suspect at some point, especially if we have a no landing scenario, price back in because, you know, we wind up getting good numbers on retail sales or something like that, you could wind up back at that 8% mortgage rate. But more or less, we're probably at or near the highs in yields basically across the board. You know, whether that's corporates or treasuries, obviously with a decent rally off of 5% in the 10-year, that's going to help drive mortgage rates lower as we continue to rally. We still think over the course of the next 15 months or so, we're going to see significantly lower 10-year treasury yields. So therefore, you should have also lower mortgage rates.
I'm looking right now at the 5-year yield as well. And that's, to me, some indication of how many cuts are being baked into the system by the Federal Reserve over the next longer term 5 years. It's gone down quite a bit, but it still is at about 4.5%. Ira, are we looking at a scenario of higher for longer that suddenly people are saying, well, it's a good thing because even if it is going to be higher borrowing costs, at least they're stable, we know where they are, at least the Fed is done?
Well, I think that's part of it, Lisa. And a big part of, I think, what's going on with the vernacular is the sticker shock. You know, when we go back to the 1990s or even the early 2000s, 4.5% 5-year yield was fine, right? That's just where we were supposed to be. In fact, you go back to the 90s, that was the lower end of the range for most of the curve. So I think eventually we'll get used to these type of yields where, you know, 3.5%, 4.5% is like the norm. We just got used to over the last 15 years interest rates being exceptionally low, and that wasn't a state that was going to persist forever. And I think once we get used to this, you know, look, a year from now we're going to say, oh, 5%'s, you know, maybe a high yield, but at the same time, you know, 4% maybe is just normal.
Ira, thank you so much for your work. Ira Jersey, he will publish today for Bloomberg Intelligence on fixed income. Equities advance up 23 on SPX. NASDAQ really doesn't participate as much, up only 0.4%, maybe exhausted from the last couple days. They got a VIX 15.25. And on the equity space, I really need to listen to this because I'm not in the market. Gina Martin-Adams joins us, Chief U.S. Equity Strategist. Come on, Gina, I got the buy ticket out for the triple leverage all cash fund. Is this a sea change moment coming out of this pandemic, or is it another day at the optimistic payroll races?
Yeah, I think we had our sea change moment in October of 2022 when we had a massive washout in sentiment and overly sort of bearish conditions emerged. This is sort of a mediocre moment, but nonetheless, it's a moment. Certainly earlier this week, we did have another sentiment washout occur in U.S. equities. It wasn't as deep as the October washout, but certainly we were prepared for interest rates to remain very high for a very long period of time. Our work suggested that as of earlier this week, the equity market was priced for a 2-year yield to stay at 5% throughout the entirety of the next 12 months, keeping us on hold in terms of valuation expansion. This does at least unlock some of that constraint on the U.S. equity market, because if we are in an environment where yields can rally, where inflation pressures potentially do continue to decelerate, we might flirt with recession, but the equity market's been talking about flirting with recession for 2 years now. So really this is about unlocking that inflation constraint, unlocking that Fed constraint, and that does allow for some upside lift in equity market multiples.
How much are you concerned about softness that gets a little too soft, right? This idea that this patch of weakness, or at least not a strong growth, it's hard to call this overly weak, a slowdown doesn't become something pernicious for risk assets.
Yeah, I'm not entirely concerned about that, Lisa, mostly because all of the cyclical segments of the U.S. equity market are trading at multiple standard deviations below prior cycle averages. You've got this really interesting dichotomy happening in the U.S. equity market, where tech stocks, and specifically the biggest tech and communications stocks in the index, have driven all of the return, or the vast majority of the return so far this year. They're the only stocks trading at premiums. But if you take, for instance, the consumer discretionary space, which is where we've had the most negative guidance, which is where most people think that some sort of recessionary experience is likely to emerge, consumer discretionary stocks, when you exclude Amazon and Tesla, are trading nearly 2 standard deviations below their pre-pandemic 5-year averages. So we're relatively prepared for an environment of slow growth. What the equity market continues to struggle with, and we've talked about this ad nauseum for the last 2 years, is not about growth. Companies are very well prepared for a slowdown in growth. They've talked about a slowdown in growth coming for a long period of time. Where they struggle, and where they probably will continue to struggle, is with inflation and inflation volatility. So if we're moving into an environment where growth slows, they can contend with that. They've largely prepared for that. They've talked about it for a long time. What they're not prepared for, and what they continue to struggle with, is an environment where growth does not slow and inflation remains high and sticky. That's the difficult point in time for equities. We certainly had that throughout much of 2022. We contended with fears of that environment reemerging over the last 3 months. So anything that confirms that that environment is going away is going to be perceived positively by stocks.
Gina, thank you so much. I'm still not brave enough to buy my first share. Gina Martin-Adams holding my hand here in the equity market, surging futures up at 21. She drives the show at equities at Bloomberg Intelligence. I'm going to say this, Lisa, it's a sea change from the BKX Bank Index with a nice bounce that we saw yesterday. Just to get up to the top of a 2 standard deviation range is up 16%. That would be the pop in the bank index, is the grimmest of grim.
Which is interesting, given the fact that it used to be that higher rates would help the banking sector, and all of a sudden lower rates helps the banking sector. There is a feeling on the street right now that suddenly stable rates, or the idea that the Fed is done, will bring so many more deal makers, issuers, et cetera, back to a market after really being on the sidelines for a while.
Just now getting a glimmer of a pause here in the various surges and movements that we see in the markets. I'll focus on equities up 20, where they were up a little more earlier. The 2-year yield, Lisa, I know you're focused there, 4.88%. But you just wonder, when people who have bet away, not short, but they've bet away, or they're just on the sidelines, whatever that means, cash or whatever, how do they interpret the week that you and I have lived? John didn't live it, but we did.
When I think about Michael Hartnett, who has been relatively bearish, and over the longer term sounds like he still is, he said that the momentum that we have seen and the trading that we have seen over the past couple of sessions does give him the sense that we could see that year-end kind of Santa Claus rally, as they call it, just simply because there is a lot of momentum behind this.
Just looked at one statistic here, the 10-year real yield coming down even more now, not a pause there. 2.18% from a 2.50%. That is a seismic move in the inflation-adjusted yield over this week. Thanks to our team for just a spectacular week. The acting Labor Secretary, Julie Su, at 10 a.m. Raphael Bostic this afternoon on Bloomberg.
The bond market bulls getting it their way this week. Live from New York City this morning. Good morning, good morning. Equities near session highs. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
From New York coming up, the payrolls data favoring the bulls as Fed officials back away from doing more. Apple puts a downer on a big week of gains. We begin with the big issue, payrolls in America.
Look at the economic data.
The jobs report. It's always important.
Incredibly important.
The labor market is the key right now.
Key indicator.
Key thing that investors across asset classes are going to be watching.
We are gradually seeing a slowdown in the pace of hiring.
Continued moderation in the labor backdrop, even if it's uneven, I think is going to persist.
It all comes down to the wage numbers.
We really haven't had wages that are slowing over the past few months.
The key thing for payrolls is really about how much support there is for the consumer.
So far, the U.S. consumer has been incredibly resilient.
We're seeing a lot of cracks in the consumer story starting to emerge.
Everybody's trying to figure out what the underlying trend in the labor market is.
How is the job market evolving over the coming months? And are you starting to see some of that job pain?
It all comes back to jobs.
Joining us now to discuss is Mohammed Al-Erin of Queen's College, Cambridge, BlackRock's Rick Reader. Gentlemen, let's get straight to it. Mohammed, your take on the payrolls data from 31 minutes ago.
So on a standalone, John, Goldilocks for markets and consistent with a soft landing for the economy. Job creation, yes, slightly less than expected, but nothing drastic, nothing suggesting a collapse in the labor market. Unemployment rate, yes, higher, but very, very little. And wage growth slightly down in terms of what we've seen month on month and year on year. So if you take all that, it reinforces what has been a very dramatic week. The only thing I did not like was labor force participation. That came down. And as Chair Powell said 2 days ago, and you saw the reaction of the market just loved it because high labor force participation is good for growth, for inflation, for stocks, for bonds. We need to continue to enhance the supply side. And unfortunately, labor force participation came down. But I think on the whole, this is going to be welcomed both by markets and the economy.
Well, you said the market loves it. Bond market loves it. We're down 12 basis points at the front end on a 2-year, 487. Rick, on a 10-year, we're down 12 to 454. It's only a few Mondays ago. We had a 5-handle on a 10-year. We're now back to about 450 on a 10-year. Rick, it's not amazing. It's not fantastic. It's not terrible either. It's not brutal. What is it?
So I'd say a couple of things. I agree with everything Mohammed said around the numbers. You know, the one thing, a couple of other points I would make relative to that. One is, you know, it's interesting, you know, we've talked about it on the show before. If you look at things like healthcare and education, another 89,000 jobs positive, there's only 150 total. You take that out and then take out leisure and hospitality, which have been strong. The cyclical components continue to moderate down. I think that's a really big deal. And then, you know, the other side of it is, you know, if you take all the economic data we've gotten, it's all indicative of an economy that's slowing moderately, very moderately, but slowing. But the labor data has been solid. I mean, look at the JOLTS report this week. Claims is still solid. The ECI is still solid. Now you're starting to see there is a lag dynamic. Now you're starting to see that for the Fed. It's a really big deal. Now that you're starting to see labor be symmetric to what you're seeing in other parts of the economy and the economic data.
Euro's down big time, dollar weaker, euro stronger, 107. For those of you just joining us, going into the opening bell about 27 minutes from now, equities near session highs positive, 0.5%. Let's get a Mike McKee view on things. Mike, you've had a third, fourth, fifth look at this. What stands out for you?
Well, I pretty much agree with what Rick says. It looks like a general slowing, but it isn't a terrible report. You look at the number, 150,000 jobs created, and you have to remember that 48,000 of them were not counted because of strike activity. 33,000 of those in the auto workers. We'll talk about that in just a second. But you get 180,000 jobs in that case, which is what the estimate was. Net revisions for the last 2 months down 101,000. Doesn't really surprise people because the number was so big last month. Unemployment rate does tick up by a little bit. And here's an interesting thing, the SOM rule. You've got to go up 0.5% based on a 3-month rolling average. We're up 0.4 now. Are we getting to the point where you might see recession? Yeah, hard to say in this case. Average hourly earnings certainly cooperating down to a 4.1% annual rate, which is what the Fed wants to see. Now, let's talk about this strike activity. 48,100 people were found off the job during the month of October, and 33,000 of those were auto workers. So what you get when you look at this overall is 180,000 or 198,000 if you put all the strikers back in, and that would have been an interesting question for the markets. And maybe you can ask Rick and Mohammed, what would the markets have done if we'd gotten 180 or 198,000 for a headline? Auto manufacturing, as I mentioned, lost 33,000 jobs. Manufacturing in total lost 35,000, but take away the auto workers, and it's only a loss of 2,000 jobs. And in 3 of the last 4 months, manufacturing's lost 2,000 jobs. Construction, though, is up. Private sector jobs, only 99,000. That might be something to keep an eye on as we're looking for slowing. And then, of course, something people will debate is we lost 201,000 people from the labor force and 348,000 in terms of household employment. That's very different than the 150 that the establishment survey found, so people may be debating that. But is this a bad report? Doesn't really look like it. It's bad compared to last month, but overall, it just shows the economy slowing a little bit.
Mike McKee, thank you, sir. Mike McKee teed us up. Mohammed, let's go there. If we added back in the auto workers, would this conversation this morning be different at all?
I don't think so, John. It would have been exactly the same. Because look at it over time. In fact, the expectation, the consensus number of 180 had that already adjusted. So I don't think we would be having a different conversation. I also don't think we would be having a different conversation about policies. No, we would be having a different conversation about what's going to drive the bond market.
Rick, do you agree?
So I think so. I mean, I generally agree. Listen, I think the Fed's done. I mean, I think that's it. I mean, we needed to see the pay. Everything else is moderating. And by the way, you look at the manufacturing data, including the earnings reports we got almost across the board. And then obviously you look at it to the extent that, which the Fed should look at the global conditions, Europe is really slowing. So I think you should assume at this point the Fed is done. By the way, month on month, we were looking at average hourly earnings and aggregate hours. And so you had flat income growth. I mean, that's, for the Fed, I think that's a big deal that it corroborates inflation is coming down, not straight line. Payroll is starting, labor now is finally starting to come off a bit. So I think it's a big deal. And I think at this point that the Fed is going to be on hold for a while, and it probably could take December out of your calculation.
Mohammed, you heard it. The Fed's done. Rick Reeder, Andrew Hollenhorst, Citi, also, the Fed is done. Mohammed, what do you say?
I agree with that. Not only do I think the Fed is done, I think the Fed should be done. And I think those numbers are just confirmation as to why the Fed should be done.
When you hear lines like this one, second paragraph, Mohammed, in the Fed statement, tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. And then you look at the move we've had this week, 40 basis points lower on a 10-year. Mohammed, do you think we're unwinding some of what the Fed stated just a couple of days ago to the extent that maybe they have to take some of it back?
Yeah, I mean, they're getting into these vicious cycles, and they've got to be careful. I often think the Fed doesn't understand enough how their words are heard and read. But John, there is a bigger point, and you've heard me. I've said consistently on your show, starting over a year ago, there is no reason for the U.S. to fall into recession in 2023. I do worry, however, about 2024. I do worry about the cumulative effects of all these rate increases. As Rick rightly said, you see weakness happening all over the place. And we hope it's a soft landing, but keep an eye on it. Certainly the global environment is not going to help us. The global environment will be a headwind to the economy. So I worry that not only are we slowing and the Fed is done, I worry that the cumulative effects of everything that has happened may push us down too far.
I'm with you, Mohammed. It matters why the Fed's done. So, Rick, let's go there. You said the Fed is done. Let's throw in the data. we're seeing a slowdown in the economy. It's not a big call to make. We've just had close to 5% GDP growth in the third quarter. You're going to see that slow down, no doubt. Rick, is that sufficient reason to sit here and say, I want to buy risk, I want to buy stocks, I want to buy credit?
So listen, I mean, this is a pretty unique point in time that the yield, we've dropped, like you said, Treasury rates have dropped significantly. We've had some spread tightening. I still think these yield levels, particularly the front to the belly of the yield curve, you can clip. I mean, buying a quality fixed income portfolio, you can still clip. We put together portfolios that are 6.5, 7. We have some that we feel really good about that are 7.5 yield without really dipping down the credit spectrum. That is pretty, I mean, that to me, if you go into 2024 and think about, gosh, I can build a lot of income, I don't have to do it by going down into low quality sovereign or corporate, that's pretty attractive. And then listen, I think equities will do their job. I mean, listen, if you don't go into significantly deep recession, which I really don't think is going to happen, I still think there's almost $7 trillion sitting in money market funds. As long as you believe we're not going to get bludgeoned, capital won't get bludgeoned by the central bank continuing to raise rates. Yeah, I think it's a pretty good environment, both for equities and for example, listen, are equities going to have this sort of incredible performance they had, particularly the big tech magnificent seven? No, I don't think so. But I think you can still have pretty good return in some of these risk assets and the yielding assets. If the Fed's not going to raise rates, your carry that you have in some of these income-producing assets in high quality are pretty darn attractive. And you saw, by the way, the last few days, you've seen some pretty good buying of those.
Rick Mohammed, stick with us just to go through some of the levels. 2 Mondays ago, in the bond market on a 10-year yield, we had 5.0187% on a 10-year. We're down more than 40 basis points from those levels. This week alone, we're down 30 basis points on a 10-year Treasury to about 453 currently. Let's get you some movers going into the opening bell. Equities like what they hear this week, that's for sure. Good morning, Abby.
Good morning, John, and welcome back. We're looking at the best week since November of last year, and this bad news is good news. Jobs report, well, it's certainly helping as yields plunge more. Some of the big tech names are higher once again. NVIDIA up 1%, in fact, heading to its best week since June of this year. We also have Tesla up 1.4%. Ruining the party just a little bit, Apple down 2.3% on that China miss. They posted about $15.1 billion worth of iPhone revenue in China versus the estimate of $17 billion, so about 11% miss. And it looks like the December quarter is a little bit light, but not plunging so much. It seems as though this risk-on mood is even helping out Apple from a deeper plunge. Risk-on mood today, John.
Abby, thank you. More on Apple around the opening bell. Coming up on this program, can we call it a Goldilocks payrolls report?
Labor market's still tight, right? So, even, I mean, and I don't really think you need to look much beyond the unemployment rate at 3.8% to say, the nation's at full employment and markets are tight.
Coming up shortly, what the latest jobs figures could mean for the White House. That's next and later. iCapital's Anastasia Amoroso, PGIM's Mike Collins join us around the opening bell.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
should definitely see the impact of the UAW strike tomorrow in tomorrow's data. The BLS released their strike report. Between the strikes, the big three, and Mack Trucks, that should be about a 30,000 job reduction in motor vehicle and parts assemblies employment. That'll rebound in the subsequent report. And I think the bigger picture is that you have put in place for some of these contracts, a return to things like, cost of living adjustments, et cetera. So this should generally mean for these workers somewhat firmer wage gains over the next few years than would have otherwise been the case.
The US labour market is starting to cool. Impacts from the UAW strike, payback from the summer pop in hospitality jobs, and slowing labour demand peeking through. And workers across sectors are more concerned than ever about layoffs. Discussions about job cuts reaching the highest level since July 2020, and global industry bellwethers like Immerse cutting 10,000 jobs to shield profitability as it expects a weaker shipping market through 2026. AMH joins us now from DC for more. Morning, Anne-Marie.
Good morning, John. While the White House is parsing through this data and preparing what the president is going to say, likely he will talk about those UAW workers, roughly 33,000 individuals that work in the car and auto plants sector, and that manufacturing were not part of this October release because they were out on strike. If they were, we would actually be more in line with the estimates for this report. So the president and the White House may want to talk about those nuances. Also a moment for him for once again to come out on the side of labor and talk about that historic deal. But overall, Jonathan, you're going to see this president talk about for the fact that this is 21 months in a row that the unemployment rate is under 4%. It's a statistic that this White House loves to promote. But the concern is, of course, as we go towards the end of this year and potentially into next year, it's one that may be waning. And then finally, I would say, given the past few weeks, we keep hearing from Secretary Janet Yellen talking about more evidence of a soft landing. Inflation is the biggest problem for this White House. They're probably going to want to say this is more evidence that inflation is coming down due to the Fed's aggressive rate hikes.
AMH, thank you. The update down in Washington, D.C. A week is a long time in this market at the moment, never mind 12 months until the next election, November next year. Mohammed, we talked about this bond market losing its anchors. The ECB, the BOJ, developments in China, the Federal Reserve. All it's taken is a 30 basis point move this week on a 10-year Treasury, and you get the feeling that people are starting to sense that maybe the old world is just around the corner. Have we fully internalized, Mohammed, this new regime?
John, we have to understand that we are in transition. For 2 years now, the bond market, in my opinion, has been influenced mainly by central bank policy. Whether it's 2022, the Fed and others having to catch up on inflation and hiking rates very aggressively, or this year when markets had to recognize that rates were going to stay higher for longer. I think the Fed actually and other central banks are going to be less of an influence. And when we look to next year, we're going to be talking about who's buying U.S. Treasuries. We're going to be spending a lot of time looking at auctions. It's going to be a different narrative. I must tell you, this is a really hard market also to figure out the technicals. For example, and Rick is better placed, if you're an investor in high yield, in 48 hours, you've seen 60 to 70 basis points of carry disappear from whatever you were going to buy. Forget about a week. In 48 hours, John, we have seen a massive spread compression, and we've seen, in addition, what's happening to Treasury. So when the yields move this much, it's not clear to me whether you attract more buyers or whether people stay on the sideline just wanting this volatility to go down. And there's no one better than Rick to give us a sense for how the technicals are going to play out.
Rick, the floor is yours.
So can I just go ahead with what Mohammed said? Next week, we're going to get Treasury supply of $500 billion. Next week, we're going to get, I mean, just reiterate, that's, by the way, that's 40 gross supply. That's 40% higher. This week is 40% higher than this week last year. The number's staggering. The amount of bills we're going to get Treasury refunding next week. Let's take the other side of it, the technicals. In the high yield market, the high yield market's $1.5 trillion market, but we're getting $500 billion of Treasuries next week. The whole high yield market's $1.5 trillion, and the issuance level is light, to say the least. I've never seen a more technically driven market. By the way, the equity market, part of why the technicals there are so well supported. This year, I think it's $800 billion of authorized buyback. There's $19 billion of IPOs. So you have buying, no selling, and the Treasury's issuing immense amounts of debt. So, I mean, in my career, I don't recall a more technically driven market than we're seeing today. And it's part of why some of these markets, single names, are so shallow. The depth of these markets is atrocious. It's because it's an incredibly technical market in almost all forms today.
Rick, when you say the depth of this market is atrocious, are you also talking about the Treasury market? And how much of a change is that?
So, the depth of the Treasury market generally is pretty good. It moves around with, and I think Mohammed said it, the auctions that we're going to get, there's going to be continued focus on can we keep pumping this much debt into the system on the risk-free rate, and that will be how you interpolate every other asset class. That's a tremendous amount. The depth generally of the Treasury market's pretty good. It's not as good as it normally is because people are uncertain about whether it's geopolitics, whether it's these big rate moves. The depth of single name equities, the depth of some of the risk markets generally are pretty thin, and a lot of that is geopolitical risk that people don't want to get in the way of it, and a lot of it is just people sitting on their hands for a while. By the way, heretofore, sitting in money market funds and clipping 5+% or bills and getting 5.60 has been an attractive way to play it. So that's part of why you've got shallow depth in a lot of other markets.
Rick, do you need to see stability in treasuries before you see stability elsewhere?
Yeah, so listen, I think the first thing is the Fed, the concept of now that the Fed has data that is consistent, inflation, employment, that shows its moderation, that's a big deal. So you don't have the central bank that is twisting around in terms of the thought process. So I think that's a big deal. And then the other is, like you say, is can we keep digesting this much supply of treasuries? Listen, as long as the backdrop is pretty good around the data and the Fed, I think you'll start to see people push out of money market funds. We saw it, as like Mohammed said, you saw it in the last 3 or 4 days, and my sense is that will be durable. It's like I say, it's a question. Listen, at some point, we're going to have to deal with how much treasury, how much government debt there is, and that to me is still a big governor on the risk markets for a while.
Mohammed, just a final word. I sense from you, you're not anticipating that stability anytime soon going into 2024.
I'm hoping for it, John. I'm really hoping for it. We've got to recognize that U.S. Treasuries are the benchmark not only internally, but internationally. And this crazy volatility, I mean, seriously, crazy volatility, means you complicate financial intermediation, you lower the standing of the U.S. globally, and you risk breaking something. So I'm really hoping for greater stability. Now it's not going to be just the Fed, and Fed communication has got to improve. It really has got to improve. There's been now several studies showing that part of the volatility we've had is associated with the way things are said by Fed officials. Let's hope that we do get it, because it's central to so many things, as Rick rightly says.
Well, they're getting plenty of practice, Mohammed. A lot of opportunities to talk again. Mohammed, thank you. Mohammed Al-Arian, Rick Reed, two of the very best every Payrolls Friday. Always enjoy your contributions, gents. Thank you. Coming up in the morning calls and later, from payrolls to Apple, the conversation continues with iCapital's Anastasia Amoroso, PGIM's Mike Collins, Tom Fortier, D.A. Davidson, with a price target cut on Apple shares overnight. We'll catch up with him in the next 30 minutes or so. Live from New York City, big bond market rally. Yields lower by 14 basis points on a 10-year, 2-year down 13. Equity market with a pop. Futures up 0.5%. Your opening bout just around the corner.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Small downside surprise on payrolls. Apparently, it's what this market wanted to see. Equities higher on the S&P by about 0.5%, and a big bond market rally taking place in the last hour as well. Treasuries look like this. Yields lower by more than 10 basis points, almost across the curve. 2s out to 30s. That's the price action. Let's get you some morning calls. First up, Wedbush downgrading Co-America to neutral, recommending defensive positioning ahead of a potential recession next year. Your second call from KeyBank upgrading Uber to overweight, expecting upside results after implementing new cost control measures. And finally, JP Morgan cutting its Apple price target down to $225 following earnings, seeing continuing headwinds due to a challenging macro environment. Coming up, more on Apple's disappointing holiday outlook with D.A. Davidson's Tom Forday. Plus, more on the payrolls report with iCapital's Anastasia Amoroso and PGIM's Mike Collins. Your opening bell up next.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Fried at BlackRock, the Fed is done. This program, the last 30 minutes. Mohammed Al-Arian basically echoing that sentiment. Andrew Hollenhorst, Citi, the Fed is done. Morgan Stanley, Adam Zettner, the Fed is done. You get the picture. That data breathes some more life into that conversation. Equities higher, going into the opening bell by 0.5%. Into the opening bell, and there it is, by the way. Switch up the board and get to the bond market. This week, equities higher Monday through Thursday. We could add some weight to the rally. We are poised for the biggest weekly pop of the year so far on the S&P 500. If the bond market yields up, then yields down aggressively over the last couple of weeks. We're down 14 basis points this morning to 451. Just think about it. 2 weeks ago, 2 Mondays ago, 50 basis points higher. This week alone, we're down more than 30. That's the bond market move. Yields down, dollar weaker, foreign exchange, euro stronger, euro dollar 107.09. That currency pair positive by 0.8%, and crude backing away and backing away. October was awful for crude. A monthly move lower on WTI, even with the geopolitical tension. 81.43 on WTI right now. We're down by 1.2%. About 40 seconds into the session, equities look like this on the S&P 500, positive by 0.5%. The one stock to watch at the open, Apple, delivering a disappointing holiday forecast and weaker than expected revenue out of China. The CEO, Tim Cook, remains positive, saying this: the iPhone actually set a September quarter record in mainland China. It's an incredibly important market. I'm very optimistic about it. Anurag Rana of Bloomberg Intelligence joins us now for more. Anurag, can you go through the reasons to be optimistic right now on this company?
Yeah, I mean, you're always optimistic on Apple in the long run. This is a brand that does not lose its shine. It has a refresh rate or I would say customer satisfaction rate in the mid-90s. So people just don't get rid of their iPhone and get an Android device, at least 95% of them. But the real problem is that people are keeping their phone for a little bit longer than usual, and that's having an impact on near-term sales.
No growth at all, but revenue growth for services, Anurag. Does that change how I value this company?
It does change, but the question at hand is, can that go on for a very long period of time? Double-digit growth in services really stood out, and it helped margins. But the question is, can you grow at that same pace? The real importance is whether China is going to remain a big market for them or not in terms of growth or kind of a double-digit growth. And I think we'll take another quarter or two to figure out if they are losing some momentum over there.
Anurag, great to catch up. Anurag Rana on Apple. That stock is down 1.6%. This market rallying hard. Monday, Tuesday, Wednesday, Thursday, again this Friday. Let's stick with tech. Block raising its annual forecast and launching a $1 billion buyback program. Ed Ludlow has more.
Good morning, Jonathan. The stock up 14%, on track for its biggest jump in a year. This is basically about users and consumers still transacting on the variety of Block, the company formerly known as Square's offerings. It boosted its forecast for adjusted profit in such a way that it's really moved the needle for the street. Adjusted EBIT for the year 2023, 1.66 billion to 1.68 billion, way up from the previously guided range of 1.5 billion. Also, just it's difficult to put too much emphasis on active users as a metric, but MAUs going up significantly in the quarter.
Thanks for that. Let's turn to the travel space. Expedia announcing its own $5 billion buyback plan after topping earnings estimates. With more, I'm pleased that we can cross over now to Abby. Hey, Abby.
Hey, John. Well, investors are really liking this quarter a lot. The stock absolutely surging right now, up about 17%. Its best day since November of 2020. On the week, up 20%, the best week right now as of April of 2020. And it has everything to do with that $5 billion buyback that you just mentioned. In addition to the strong results, they beat both earnings and revenue. They put up adjusted earnings of $5.41, so not a small number. That was a 33% beat. They also put up revenue in a very solid way that beat by about 1%. Hotels, that beat. Interestingly, airlines, a little bit of a miss. But again, investors really liking this, and analysts as well on board with this very strong quarter and the buyback for Expedia, John.
The stock is up 16%. Abby, thanks for that. Let's turn to gambling. We can get to DraftKings. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yes, strong showing from DraftKings. Strong user engagement. Losses narrowed. Guidance was boosted as well. Let's go through that in order. Monthly unique players increased on the platform to 2.3 million in the quarter. That is a 40% jump from the prior year. And you also saw revenue per player increase as well. Now, DraftKings, it did post a third quarter loss of about 62 cents a share, but analysts had been expecting a loss of 69 cents a share. And just for context, DraftKings saw a loss of $1 per share in the same period last year. So obviously a big improvement there. And lastly, DraftKings also raised its fiscal year revenue guidance as well. And the sell side is psyched, to say the least. You take a look at this note from Truist, which already had a buy rating on DraftKings. The analysts had expected the results to be a, quote, standout, but analyst Barry Jonas said after the report that these results already surpassed his high expectations. Added together, you can see DraftKings absolutely flying this morning, up about 7.5%, John.
Katie, thank you. This market's been flying. Let's get to iCapital's Anastasia Amoroso, PGIM's Mike Collins. Anastasia, what a week.
It's been a week for sure, John.
This move in the bond market, you seen a recipe for further bond market stability after that payrolls report?
I mean, I do, and I think it's not just about the payrolls report, but several factors that have been propping up the bond yields here. You know, first of all, the payrolls report was picture perfect, I would say, for the Fed, for the equities market, and for the bond market. The reason I say that is because we got an uptick in unemployment rate, we got the slowdown in the pace of job creation. So that really tells you that the economy is likely to slow from sort of the breakneck speed that we saw in the third quarter. So that's easing some pressure from the bond market. But then I think there are two other developments this week that are really important. And one, of course, is from the Fed. They really are taking note in the long end of the curve and saying that is likely tightening financial conditions. But then you couple that with the announcements that we got from the Treasury this week, which is on the borrowing that they're going to do and exactly what they're going to issue. And I think that was a really good piece of news for the market, because they're not what they're going to borrow sort of met estimates or maybe even undershot it, and they're going to borrow mostly in the front end of the curve. So that's easing the pressure on the long end of the curve. So you put all of those things together, and I think we do have a recipe for a pause, if not a further fall in yields. And of course, John, as we talked about, you want to buy those spikes in yields. You want to buy the tech on those spikes, and hopefully investors have been doing that throughout October.
Mike, you feeling a little bit more comfortable now in fixed income?
Yeah, Jonathan, I think the bond market, interest rates in the bond market are now actually just coming back down to earth. When they were hitting 5%, and the Fed funds rate that was priced in permanently was pushing at 4.5%, I certainly thought interest rates across the curve were probably 50 to 100 basis points too high, that they overshot. And we saw that really with the inflection a month ago in the big jobs number we had. Of course, now with this volatility in the market, we've seen a full, as you pointed out, 50 basis point retrenchment, not only in the 10-year, but in the Fed funds rate expectations now are for a funds rate kind of in the 360s by the end of 2025 and 2026, which seems a lot more reasonable to us. So maybe now bonds feel more fair value.
So, Mike, what have you been buying this week?
Yeah, so, you know, we actually took advantage, Jonathan, on the credit side. As you know, we were short duration probably most of the early part of the year. We covered that in and have been kind of neutral here with this big backup. On the credit side, though, as Mohammed pointed out, you actually had a big backup in credit spreads. I mean, high yield spreads widened over 100 basis points from where they were, you know, a year and a half or so ago, and getting into the mid 400s was a pretty attractive entry point for us. So we've been buying a little bit of front end high yield and other high quality credit on the margin with the backup we've seen. But of course now that value proposition has kind of been wiped out pretty quickly as well. So really, like always in the markets, Jonathan, what to do now is always the hardest question.
Yeah, this is stuff we should have probably done yesterday. Anastasia, let's build on some of that and breathe some life into the equity side of the conversation. The banks this week, fantastic. This week, good. This year, terrible. Is there something to like now?
I mean, I don't like the banking sector, John. And, of course, like everything else, the banks can also rally into year end if we have this pause in yields and still constructive sentiment. But my concern about the banking sector is that I do think 2024 is going to be a harder year from the perspective of the economy, and especially from the perspective of charge-offs, delinquencies, bankruptcies, and defaults. And if you think about what one sector is most likely to feel all of that, whether it's defaults in commercial real estate, whether it's bankruptcy filings, whether it's consumers defaulting on perhaps their credit cards, I think it goes all right back to the banking sector. So for that reason, I'm a little bit more cautious on the banks. And then, John, the other issue, with the banks, there was a period of time where I did have some optimism for the sector, and that was predicated on the return of capital market activity. But we haven't seen really that return materialize in the third and fourth quarter so far of this year. So I think it's really too early to say that that's going to prop up the earnings of those banks. So I'm sticking with technology. And if you look, John, for example, at the NASDAQ, the S&P did pierce below 200-day moving average. The NASDAQ 100 never did, and it bounced right off of that level.
So from your perspective, the best way to play bond market stability, I should rephrase bond market stability as a bond market rally, is not through, say, the financials. You think it's still through tech?
Yeah, I absolutely think so. I mean, tech has gotten, I would actually characterize it as unfairly punished by higher bond yields. And when I'm talking about tech, I'm specifically talking about the profitable technology. And the theory goes that higher bond yields impact negatively tech valuations. And maybe that's true, but if you think about it from the fundamental perspective, tech is really not that much impacted by higher yields because tech is one of the sectors that has the lowest leverage in the S&P. And if you think of tech, they also don't have a whole lot of oil leverage either. So I actually think it's one of the more immune sectors from these macro headwinds. And again, if I look at tech today, it's trading, lower in terms of multiples than it was during the summer. It's bouncing off the technical level. So I think that's the best way to play the retracements we're seeing in yields.
It's an easier story to tell with yields 50 basis points lower than where they were 2 Mondays ago on a 10-year. Mike, can we just talk about where we've been and where you think we're going? I mentioned this to Rick and Mohammed. When you get a rally like the one we've had this week, there's always this temptation to extrapolate that out and start to think about the world we were used to only a few years ago. Mike, what is it about this regime that you think might stick for the next several years?
Yeah, our biggest worry, Jonathan, and Randy Prosser on your show pointed this out earlier, that the Fed is going to be very reluctant to cut rates here, right? So now there's 100 basis points of cuts priced in next year and about 75 in the following year. Maybe that happens, right? And I think you would really need a steady kind of slowdown for that to happen. But I think the Fed is going to be late to the game. They are going to err on the side of keeping the funds rate higher than they should for longer than they should. Probably at least for the next phase of this cycle. So if you do have a slowdown, the risk is that you don't have the monetary, stimulus, and you certainly probably won't have a lot of fiscal stimulus given the dysfunction in Washington to provide that support that we've all become used to. So you could have a period of a couple of years of just kind of below trend, sluggish, maybe even a mild recession type of environment where you don't have that government, impetus to support. So that's really one of our concerns. Our fundamental analysts are looking from the bottom up and starting to see a lot of those cracks emerge, right? And if these short rates stay higher for longer, and obviously you've had a big relief on the rest of the curve in the last few days, but it does put pressure on companies and consumers and all kinds of businesses and commercial real estate as time goes on. So that's really what we're focused on.
Mike, Rick mentioned the supply dynamic into next week. Just going through treasuries, 3-year, $48 billion next week. Next week also $40 billion of 10-year notes, $24 billion of 30-year bonds. We're rallying hard into that, Mike. Is that going to go okay?
I think it'll go fine. This is probably the question we get most from our clients, at least in the last few months, Jonathan, is supply. What is going on, right, with the U.S. government supply? And actually, if you look at our debt to GDP, it has come down steadily since the peak in COVID because the denominator, nominal GDP, is up 38%, Jonathan, in this country in 3 years since the bottom in COVID. That's the biggest gain in nominal GDP we've seen since right after World War II. So I think Our debt situation is probably more sustainable than people are worried about. Supply dynamics historically do not have any empirical relationship really to the level of interest rates. It's been a global bond sell-off. And if you look at the world and the bond market opportunities, I think the U.S. market is still really attractive to foreign investors and even to U.S. investors.
Mike Collins, Anastasia Amoroso, to the two of you, thanks for being with us. A constructive view there on both fixed income and parts of equities. About 14 minutes into the session. If you are just joining us, where have you been? 150,000, downside surprise on payrolls, the estimate 180. That's the number for the headline number on payrolls. The reaction, equities up and up big, up 0.8% on the S&P on the session, on the week, up more than 5%. We're down hard on yields on a 10-year, down 17 basis points on the day, down more than 30 basis points over the previous 5 sessions. On a 10-year right now, we've broke 450 at 449. Coming up, Apple delivering a disappointing outlook for the holidays.
I do think there is one reality, and that is that I think Apple has come to grips with the fact that it needs to have a more diversified kind of Asia strategy.
More on Apple's latest results with D.A. Davidson's Tom Forte. That conversation up next.
I know one of the reasons you're here in Marrakesh and in Africa, because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
So you told your mother you'd like to go to Africa and see the chimpanzees, and what did she say?
Not the chimpanzees, I would have studied anything.
Well, what did your mother say to anything?
If you really want to do this, you're going to have to work really hard, and if you don't give up, hopefully you find a way.
No secret that consumer and government sentiment hasn't been all that positive around Apple for the last, I'd say, couple of months in and around the greater China region. And yes, I mean, we have heard rumblings that competition is greater perhaps now than it was over the course of the prior year. I do think there is one reality, and that is that I think Apple has come to grips with the fact that it needs to have a more diversified kind of Asia strategy.
Apple delivering a disappointing holiday outlook, a fourth consecutive quarter of slowing sales with weakening revenue out of China. The CEO, Tim Cook, saying this: we continue to face an uneven macroeconomic environment, including foreign exchange headwinds. D.A. Davidson cutting its price target down to 166 after the results, writing the following: China risk is high. The weak macroeconomic conditions are negatively affecting sales. There's escalating tensions between governments, and the company is still overly dependent on China's supply chain. I'm pleased to say that Tom Forday joins us right now. Tom, great to catch up with you, buddy. One thing you didn't mention there, I don't think, was competition within China domestically. Tom, is that showing up at all?
It is showing up, but the way that I think about the China pressure is primarily the challenging macroeconomic environment. You had a very muted reopening trade after the end of COVID-0, and then secondarily, the escalating tensions between the two governments, with Apple kind of caught in the middle.
You know, the revenue mix is shifting. Services growth is better, Tom. Margins are still healthy, better than good. Is that enough to hold up this stock from your perspective, in your opinion?
Services is good, but they need to have more hardware ultimately to get more services. My concern is this puts more pressure on the Vision Pro, which is expected to come in the beginning of calendar next year, but with a $3,499 price point, or $3,499, and likely not getting the subsidies from the wireless carriers like the iPhone, I think the next 12 months are going to be challenging for the stock.
Tom, that's the big question. China down, Europe down, Japan down. You mentioned the hardware challenges. Are they losing pricing power?
I don't think they're losing pricing power. So if you look at the iPhone results, they essentially benefited in the 15 from a de facto price increase. They're not offering the lower memory option, which means if you want the Pro Max, you got to pay $100 more. I think they have pricing power. They're trying to increase prices on the services. But again, the challenge is if they don't get more hardware in the consumer's hands, can they continue to grow services? And given the relative higher margin, can they maintain their multiple? And I think that's in doubt.
Tom, you've cut your price target. I understand that. If you told me all of these things at the start of the year, there is no way I would have guessed the stock would be up year to date by more than 30%. Which begs the question, Tom, what is driving the stock? And why would that change?
What drove the stock was a flight to quality in a very challenging period for the stock market. You had, bank closures, things of that nature. And then excessive enthusiasm about, either the China reopening or the company's ability to continue to pump the iPhone and generate shares higher. I think that's what drove the stock performance. It's a great company, generates a ton of free cash flow, but the challenges are very significant. As you pointed out, 4 consecutive quarters of declining revenue to be followed by a flat quarter. It's tough.
What kind of multiple, Tom, does this company deserve now?
I think that the current state of the business, it's hard to suggest you get more than a mid-teens multiple, with the mid-teens driven by the quality of the company, the very significant free cash flow it generates, and the potential that after they slog through kind of a couple more challenging quarters, growth returns and resumes. They still have to manage the overdependence on the iPhone, which is another challenge for the stock and the multiple.
Tom, appreciate the update, as always. Tom Forday there of D.A. Davidson on the latest. Thank you, buddy. As always, the stock is down 1%. The market's up 1% on both the S&P and on the NASDAQ as well. Let's get you some sector price action. Here's Abby.
Not surprisingly, John, very bullish sector action. 10 of the 11 S&P 500 sectors are higher. And very interesting, it's not the usual sectors that are on top. We have real estate, consumer discretionary, materials, and utilities. Real estate, the best one, up 3%, having to do with yields plunging. Those dividends look more attractive. On the week, we have a similar situation, just energy down. The top sectors on the week, there you have real estate. The best week, John, going all the way back to 2021. And as you mentioned, the S&P 500 on this broad sector strength, well, the best week of the year.
Big day of gains, big week of gains. Abby, thank you. Coming up next, your trading diary, a sneak peek of next week.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
This market is absolutely flying. Stocks up across the board. That's the price action. Let's get to the trading diary. Coming up, what you need to be watching this week, the ISM services coming at the top of the hour. Then next week, you get a ton of bond issuance, 3-year, 10-year, 30-year, along with earnings from Uber and Robinhood and eBay as well. Wednesday, Disney after the close. And on Thursday, you'll hear from a load of Fed speakers, including Chairman Powell. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Enjoy your weekend. This was the countdown to the open. This is Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything. News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to kick it off in just moments with Julie Su, Acting U.S. Labor Secretary. She's going to join John Farrow, break down those October jobs number. Tom Gimbel, CEO at LaSalle Networks. He knows a thing or two about hiring and firing. Big network there, hiring folks. So we'll get his thoughts on these jobs numbers. Again, the jobs numbers came in below expectations. Unemployment ticking up, so some big news on the jobs front. Our C-suite conversation, Greg Ebel, CEO at Enbridge, joins to discuss the oil industry and how it's being impacted by mergers as well as geopolitical conflicts. So a lot coming up just in this first hour. Let's kick it off with John Tucker, Bloomberg Business Flash.
All right, risk on in today's session. Stocks higher. Treasury yields, they are plunging on bets. The Fed's done with this evidence of slowing in the labor market. The swaps market now pricing a rate cut in June, moving that up a month from July. Jeff Rosenberg at BlackRock reacting to this morning's jobs report.
This is a report that helps to support the narrative of slowing in the labor markets, slowing in wage inflation. But across the board, especially with the revisions, it just looks like this is coming in slower. And so that helps to feed the near-term narrative that you get to the soft landing.
Right now, Apple shares keeping a lid on advances after their outlook disappointed. Shares right now down 1.1% for Apple. And we had some breaking economic news. The Institute for Supply Management Services Index coming in a lighter 51.8. The reading there, we expected 53. The prior month was 53.6. S&P 500 up 42 points. That's up 1%, 43.59. The Dow's up 204 points. NASDAQ 100, 139 points higher. That's up 0.9%. Back to those yields. The benchmark 10-year, 12 basis points lower, 453. The 30-year, the long bond, 9 basis points lower. That's at 470. And we check the markets for you all day long. Right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much.
I have to chuckle.
Yes, we do. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We are also streaming live video stuff on YouTube. So head over to youtube.com and search Bloomberg Global Radio. So, Matt, quite the jobs number here today. Again, the print came in, change in non-farm payrolls, 150,000. The expectation was for 180,000. So a meaningful miss there. And also note the downward revision from last month from 336,000 to 297,000. So a little bit, certainly a defined weakening. 2 months payroll net revision minus 101,000 jobs. Yep. So the labor market just not looking as strong as we had seen it previously. Still, it's better than a stick in the eye, right? Yep. But it's just not the unbelievable, bull strength that we'd previously seen. And my personal argument for anybody who's arguing a recession, I was like, how can you have a recession with such a robust job market? So maybe we're starting to see. We definitely can. Anna Wong put out some research yesterday pointing out that does not make a good indicator. Oh, okay, we've got the SOM rule though, which posits a slightly higher change of 0.5 percentage points as a threshold for a recession. Right. So she's saying if you see that, then it's recession, not you have to see that for a recession. Right. Yeah. And just for what it's worth, the unemployment rate, 3.9%. Consensus was for 3.8%. Let's go to Tom Gimbel. He's the CEO at LaSalle Network. LaSalle Network is a group that finds people jobs. So Tom knows all about the labor market. Tom, what do you make of this labor print here today?
Right. It's better than 150,000 is better than a stick in the eye. But when a third of the 150,000 comes from government, you have to wonder how much is being propped up. So I think that, maybe we're really looking at the soft landing that the Fed's been talking about for so long. I think the one thing I would disagree with what you guys are saying right before I came on is, if someone tells you it's a recession and all of a sudden you hide in your house, then it's a recession. I think we have to stop waiting for something to happen and go about our business and realize that stock market's up, unemployment's still under 4%. There's opportunities that exist for jobs in the market and the economy. We've just got this situation with COVID hangover and inflation that it's really hard to shake.
The problem with that, though, Tom, is that if you're running a large business, if you're managing a lot of money, if you're managing a lot of headcount, you've got to plan for the future. And if we're in for a recession, you need to try and get ahead of that. How do you see?
I see that's the problem. That's like a run on the banks, right? Is that if you think there's going to be a recession, you got to plan ahead of it and lay people off or do whatever you need to do from a cost side of things. And what does that do? It feeds into the recession. And it's kind of like making a run on the banks during the Depression. And I think that it's real and it's true, but this comes back to a bigger issue. But, quarterly earnings report, right? That's why they have to do it, because they don't want to get screwed by the street on quarterly earnings. True. And that might not be the best thing overall for the economy or even for their company, when in 9 months they're going to need to hire those people back, and we're coming through from getting out of the recession. Why are we out of the recession? Because we have 2 consecutive quarters of positive GDP growth coming after 2 consecutive quarters of negative GDP. It's just a self-fulfilling prophecy, guys.
Hey, Tom, we're going to ask you to stick around here because we're going to go right now to Julie Su, interview with acting U.S. Labor Secretary Julie Su for reaction on the jobs numbers. She speaks with our own Alex Steele and Guy Johnson. Again, the print came in a little bit lighter than expected. So again, right now, let's go to acting Labor Secretary Julie Su right now for that discussion.
We welcome now our Bloomberg TV and radio audiences. U.S. jobs numbers coming out just about 90 minutes ago, showing a cooling in the labor market and a rise in unemployment. Here with us now is Julie Su, acting U.S. Labor Secretary. Secretary, what do you think of the numbers? What's your first take?
It's a good jobs report. It shows steady, stable growth. I know we've been saying that for a couple months now, but this last month's number was 150,000 jobs created. It brings the total since President Biden came into office to 14 million, at the same time that we continue to see unemployment rate under 4% for 21 months straight. That's the longest in over 50 years.
Madam Secretary, good morning. It's Guy. Many Americans are dealing with very high inflation and continuing to deal with that very high inflation. It's eating into their pocketbooks every week. It's eating into the amount of money they take home. Do you think a softer labor market is a price worth paying for lower inflation?
Yeah, thank you, Guy. I mean, I'll put this in context, right? Over a year ago, President Biden said that if we started to transition from the red hot numbers for job growth that we were seeing at the time, it was like 500,000 a month, to something more like 150,000, it would be a sign that we were entering into steady, stable growth. And a lot of people said that would not be possible, that we would not bring unemployment below 4% for several years. And President Biden's economic policies have defied that expectation, but also, to your point, that we would not be able to control inflation at the same time that we keep unemployment down under 4%. And so we're continuing to invest in and pursue economic policies that are doing both of those things, bringing down inflation so working people have a little bit more room, and also making sure that the employment rate remains as low as possible.
So let's go to that, because 3.9% for the unemployment rate, we are really close to 4%. And many economists think that if you get to that 4 level, that's usually the trigger point, the tipping point for then a recession. What do you see?
Well, these numbers are still inconsistent with a recession. They're much more consistent with what the president has said, which is steady, stable, sustainable growth. The 150,000 number from last month, if you take the overall, even with adjustments, the 3-month average is still 204,000. So we're continuing to see job creation and confidence, and workers in the labor market, and employers, opening up businesses and continuing to create jobs.
Madam Secretary, one area of weakness within the U.S. economy at the moment appears to be manufacturing, which in some ways is surprising. We saw it in the ISM data earlier on this week. We've seen it with the employment data that we've seen today. Do you think that we're in a situation where we haven't yet fully seen the impact of the IRA and the stimulus that is likely to bring to the manufacturing sector kicking in yet? When do you think we're going to feel that effect? And are you surprised that manufacturing is doing what it's doing right now?
I think that is absolutely right, that the investments that are being made, they're historic in nature, but they're not going to come all overnight, right? Some of it is, we're still building the factories that are going to house the manufacturing. So that growth we expect to continue as we reinvest in American jobs, American-made goods. But the other thing to note about last month's numbers in manufacturing is it does reflect the historic United Auto Workers strike. And so that strike has been resolved. Obviously, the members still need to ratify the tentative, but we saw historic gains for working people in that agreement, and so with the strike ending, I think those numbers will we'll see an adjustment back in the next month.
To that point, though, Sean Fain was talking to Bloomberg earlier and said that he's ready to go after Tesla. There were really good concessions that were made to workers in the auto strike agreement, and I'm wondering if you guys are anticipating more strikes. Workers have bargaining power; they got a good deal.
So two things about that. One is that we certainly see, we imagine that the future of this industry, the auto industry, even in a period of massive transition, can be characterized by good middle-class union jobs. That is our hope, and that is what the outcome of the UAW's negotiations with the Big Three demonstrates. But the second thing is we are seeing, in light of the achievements of the UAW and the Big Three in their bargaining, that there are other companies that are already starting to increase wages. And so that is the ripple effect of what unions can do. It's creating benefits not just for their members, but for entire industries.
Madam Secretary, one of the biggest changes we've seen in the labour market in the United States post-pandemic has been that many women have come back into the labour market. And this has been fantastic. And I think it is something that we all applaud. What we have now seen is some of that pandemic-era child support rolling off. And I'm wondering if we're already starting to see within these numbers the impact of that fewer women are in the labour force. What would your answer to that be? And do you okay, so if it is an important question, what can the administration do to reverse potentially some of the dire effect that comes from that support rolling off?
Yeah, so I've said that women have really helped to power this economic recovery. Women's employment ratio remains at historic records also. For 7 months, it's been a record since something like 1948. And so women were devastated during the pandemic, right, and came back in record numbers. And of course, the availability and affordability of high-quality childcare remains critical for women's labor force participation. The president has called on Congress, and we do, to make sure that there is a care infrastructure that matches the roads and bridges and other infrastructure of this country, and we want to continue to see that. Now, having said that, we did see that in the October numbers that overall healthcare jobs increased. It was the highest increase across any sectors, 58,000 jobs, from hospitals to social assistance, which includes elder care, to care jobs overall.
Madam Secretary, on the flip side, we saw black women unemployment jumping to 5.3%, the biggest one-month increase we've seen since May. And I'm wondering if that's a direct result of losing the child care.
Right, so we have to maintain laser focus on equity and ensuring that every single family and community is included in the growth that we have. The president talks about this all the time here at the Department of Labor. I get to travel around the country and see training programs that we have that are focused specifically on communities that have been left out for far too long. And so we know that there continues to be work to do in that space, and we're going to continue to do it.
All right. Thank you very much. We appreciate it, Madam Secretary Julie Su, acting U.S. Labor Secretary.
All right, very good. That was Bloomberg's Alex Steele and Guy Johnson having a conversation interviewing acting U.S. Labor Secretary Julie Su on the little bit weaker than expected jobs number here. The change in non-farm payrolls came in at 150,000. The consensus was for 180,000, so a little bit lighter there. We had a revision downward last period as well.
There's amazing tone of that interview, right? I mean, We added 150,000 jobs. Unemployment is less than 4%, and yet the labor secretary was at pains to defend President Biden's record on the economy. She was like struggling.
That's her job, dude.
I know, but you know,
she's acting. She wants to get the real gig, maybe. I don't know.
I don't know. I mean, it was definitely, she is for sure a surrogate. I mean, that was just all political.
You would have been all over that. All right, let's bring back Tom Gimbel. He's the founder and CEO of LaSalle Network. LaSalle Network is one of the largest national staffing entities out there. So, Tom, again, 150,000 seems like a good number. As you talk to your clients out there, the businesses that are hiring, what are they telling you about kind of their needs over the next, I don't know, 3 to 6 months if they can go out that far?
Sure. Can you guys hear me okay?
Yep.
Yes.
Okay. So what we're seeing is the small and medium-sized businesses, the SMB market is doing really well. We're seeing the large cap companies are the ones that are having the bigger challenges. And that's, you know, it parallels what we've seen through the beginning of the year with Microsoft and Google and the big tech companies doing layoffs. And we're continuing to see that. We still see that cybersecurity continues to be, and technology investment overall continues to be strong. And I think we saw that in the Gartner results that came out this week. So that technology continues to be an area that companies are investing in, and we're going to continue to see growth there. But I think what you said about the labor secretary is right, is it's for the first time, if we take out the government jobs, we're only looking at under 100,000 jobs added, and that's not necessarily a booming economy.
All right, so what do you think we're going to see in, you know, Q1, Q2? Because we've already seen big layoff announcements come from global companies, from U.S. companies.
How about Maersk? I saw that.
Yeah, Maersk 10,000, right? But that's a global thing.
Yep.
Still, it's a bad indicator, right? Because they're shipping. And if shipping is slowing down, that's a problem. We saw Schwab the other day cutting 5 to 6% of the workforce. I mean, are we going to start to see more and more pink slips? Because we haven't, Tom, really seen that this year.
Yeah, logistics is getting hard in general. So what Maersk did, I'm not surprised by, and I think we'll see that a little bit more coming from the big logistics companies, especially with what's going on worldwide. That you're going to see a lot of things settle down, both business and consumer spending, I think, after we get through this holiday season. And so my guess is that in the early part of the year, you're going to see that unemployment number rise. I think you're going to see that. But you guys know as well as I do what happens is that to meet their numbers, companies are going to cut too far to the bone. And that means the second half of the year leading into an election, that there's going to be some hiring coming on. So my guess is first quarter of the year isn't the best we've ever seen.
Right.
But when we move into the third quarter, we're going to be pretty optimistic and bullish.
All right, Tom. Great stuff, Tom. Thanks for sticking around. I really appreciate it. Tom Gimbel, he is the founder and CEO of LaSalle Network. I'm going to break down non-farm payrolls. This is Bloomberg. Let's go to Elise Mateo right now for some company news.
Good morning, Paul. Apple is expecting a disappointing holiday quarter with weak China sales. But Bloomberg's Intelligence's Mandeep Singh says it's a mixed print.
When you think of the expectations and where they came, and with all the headwinds coming out of China, you know, with the softer demand and the ban, the iPhone print wasn't bad. I think it's the Macs and the iPad where obviously the declines were double digit, and the guide didn't suggest any recovery for 4Q.
Now, Singh also adds that services was a bright spot. Apple found ways to drive double-digit EPS growth even with revenue flat. Apple shares right now, though, they're down about 1.5%. Sticking with tech earnings, Block is raising its annual forecast and launching a $1 billion buyback program. We get more from Bloomberg's Ed Ludlow.
This is basically about users and consumers still transacting on the variety of Block, the company formerly known as Square's offerings. It boosted its forecast for adjusted profit in such a way that it's really moved the needle for the street. Adjusted EBIT for the year 2023, $1.66 billion to $1.68 billion, way up from the previously guided range of $1.5 billion.
Now, shares right now up more than 12%. After its role in several major hacks, Microsoft has had enough. The tech giant says it's revamping its cybersecurity protection. It plans to use artificial intelligence and other methods to speed up the company's response to those vulnerabilities. And meanwhile, Boeing, well, it's been hit by hackers. Its website that sells spare aircraft parts, software, and services, well, it was offline yesterday due to a cyber attack. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Green on the screen, the S&P 500 pushing toward its fifth straight day of gains, with the benchmark also on track for its best week this year. Investors cheering the jobs report. It's weaker and reinforces the idea the Fed is done with rate hikes. The swaps market also betting on rate cuts in June. Tesla shares most active. They're up 2% right now. Fortinet shares, they're a standout. They're down 16%. They missed estimates and cut their forecast. And because of its weighting, let's do Apple. Down right now 1.5% after the earnings report. $174.91 this year. S&P 500 up 37. That's up 0.9% at 43.55. The Dow Jones Industrial Average up 199 points right now. The Nasdaq 100 105 points higher. That's up 0.7%. The benchmark 10-year yield 11 basis points lower. That's at 454 after the jobs report. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Let's talk a little energy right here. I'm looking at WTI crude oil, and it is kind of come off that big high we had before. WTI crude oil sitting here off about 1% today, $81.56 per gallon per barrel. Sorry. Greg Ebel joins us. He is the CEO of Enbridge Energy. It's a New York Stock Exchange listed company. The ticker is ENB. The company reported some earnings today. So, Greg, talk to us about. Thanks so much for joining us here. Talk to us about kind of what you guys reported with your latest earnings results and kind of what's the outlook you're telling the street these days.
Yeah, for sure, Matt. Paul, great to be with you again. And yeah, a very solid quarter, both operationally and financially for us, right across all of our business. You know, we saw record volumes and results on the liquids business. Our mainline pipeline system saw record volumes. Our export facilities saw record volumes. And so we beat, obviously, the street estimates for the quarter, which is great, and reconfirmed that we would meet our goals for the full year. year. And we announced a little bit of tuck-in M&A. We bought some renewable offshore wind facilities that we had originally participated in Germany, and then renewable natural gas facilities in the United States. All very long-term contracts, 10 years or more, and all very consistent with that, all of the above approach that I think the public want, that investors want, and that actually creates a lot of value for. So we're pretty excited about the road ahead.
Why is, the stock's up today, but why is it down 13% year to date? Is it the underlying commodity that's a problem? Is it concern about demand? What's holding the stock down?
You know what? We have been, and very proudly so for decades, increased the dividend year after year, very utility-like in that structure. And as you guys pointed off just a few minutes ago, with interest rates that have been up, that impacts dividend-paying stocks like ourselves. And as you've seen in the last, call it 4 days, what we've seen 40, 50, 60 basis points coming in on the 10-year, you've seen the stocks that pay dividends react. So it's not the commodity, it's not energy demand. We see up those. We don't have commodity exposure. Really is that 10-year interest rate side of things. So that's a macro factor that, frankly, I can't do anything about. What we can do is make sure the company runs well, meets its earnings targets, and continues to build up both organic growth and some of these acquisitions.
Greg, talk to us about, again, you mentioned some of these acquisitions and the investments you make in renewables. Realistically, do you have a good handle on the types of returns you can get on renewables? It just feels like maybe some of the shine is off that side of the energy business.
Well, it's a good point. I think investors are starting to figure out that renewables are all not built the same, right? So those that have long-term contracts, in other words, 10, 15-year contracts with great counterparties, so larger utilities or big industrials, those are the ones you want to participate in because, they've got a guaranteed price set on that power. They've got a great investment-grade customer that's taking that power, and you're going to get paid. Those that are kind of going in a merchant world and haven't got these things contracted, or in jurisdictions where it's extremely difficult to build things, which is a lot of jurisdictions these days, I think you're seeing those entities being, a lot tougher to get the returns that the ones I previously talked about, which is why our renewable business, which we've actually been in for 20 years, is all about that contracted business. So our European stuff, our customers are folks like EDF, Electricité de France, or the government in Germany. And then here in the US, most of our customers would be utility-like players. And even on the renewable natural gas tuck-in that we had today, we have 10-year contracts with the likes of BP and Shell. So I think, and I think this is great for companies like Enbridge who have done it on a low-risk basis, that you're going to see differentiation. Those that have actually structured their businesses to create good returns, double-digit returns, are going to be rewarded, while those that have gone more merchanty, I think that's going to be a tough slug for them.
Where do you see demand going for energy? I mean, as we see the jobs numbers miss, and as we expect either a soft landing or a recession, I imagine demand slows down. Is that the case?
Yeah, typically energy is about 2/3 of GDP. In other words, energy growth grows about 2/3 of GDP. So if you thought GDP was going to be 3%, you get energy at 2%. That's one. Two, remember, people don't shut off their lights and they don't turn off the gas in their house, even when you're in a recession. Where you see it is on some of the industrial load, but most of our stuff is for ultimately residential players. So I don't see that has any big impact. But remember, we're building assets for 10, 20 years. So virtually every report that you would see globally and in the United States, we will be using more energy 10 years from now than we use today. And particularly so in developing countries, you're going to see them continue to move up the economic food chain, and that always requires more energy. So some of our assets on the export side of things, whether it's our liquefied natural gas export facilities we're building on the west coast of Canada, or our oil export facility on the Gulf Coast of the United States, which is the largest in the U.S., you continue to see very good response there, even through recession. So, yeah, I think the demand comes down a bit, but it continues to grow.
So I saw you announce intentions to buy some utilities, I guess in Ohio, North Carolina, and Utah. I mean, it's a big number, $14 billion. What's the strategy in the utility biz?
So we're, it's interesting, maybe a little bit of contrarian, but I think we're right on this. We've been in the utility business for a long time. We've got the largest gas utility in Canada. This will make us the largest gas utility in North America by volume, serving some 7 million customers in jurisdictions that are really gas friendly. So they actually have ban legislation, if you will. They will not allow communities to ban natural gas. They know how important it is for industrial growth. Think of what's going on in Ohio, so much from a steel, automotive, refining perspective, gas is critical. And then growth areas like North Carolina and Utah, very favorable environments. So we saw that, and it fits right into our dividend paying, low risk environment. And gas continues to grow. In fact, these utilities, you will see their rate base, or if you will, their customer setup and the assets that they use grow by a compound annual growth rate of 8% through the end of the decade. So that was our strategy. We had a seller that was largely an electric player that had to move out of that business for other reasons related to its electricity business. That created an opportunity. We were able to buy that as historic lows, 1.3 times that base of the business. So we're a big enough player we could buy all three, and that's really exciting for us as we move and close those in 2024 and have them fully in the barn and ready to produce in 2025.
So I'm looking on the Bloomberg terminal, Greg, and I see a dividend yield for you guys of 7.6%. I mean, that is just huge. What's the dividend policy you kind of communicate to your shareholders?
Sure. So we pay out, and we've been paying a dividend for forever, and it's an important part of our equation. I think our compound annual total shareholder return is about 11% since 2000, and you go back to the 60s and you'd find it about a similar number. And the philosophy there is, as we build these low risk projects and we bring them in, we can pay out 60 to 70% of that cash flow to investors through dividends. And so the higher yield right now is really driven by, as we talked about, the 10-year yield having an impact on that. People will put their money in U.S. Treasuries versus some dividend-paying stocks. So I would expect that to come down, the stock to go up as you see some softening on the yield side of things. But that 60 to 70% payout, very comfortable for us, very much in line with our cash flow, and allows us to retain enough cash to continue to invest in the business.
All right, Greg, thanks so much for taking some time. I know you guys are busy today with your earnings. Greg Ebel, he is the CEO of Enbridge Energy. ENB is the ticker. I'm looking over the last 5 years, compounded annual return of about 8.5%. Better than its benchmark index, so some solid returns there. And the stock's up slightly here today. S&P 500, we got some movements in the markets today on the back of that softer than expected job numbers. The S&P is up about 0.8%. Same for NASDAQ, and the 10-year Treasury off 10 basis points, 4.88%. So no more of that 5% number that people enjoyed there for a cup of coffee. 10-year Treasury, it's down about 12 basis points, 4.54%. On your 10-year Treasury. WTI crude oil off 1.4%, $81.30. With our news in New York City, here's Michael Barr.
Paul, Matt, thank you very much. Secretary of State Antony Blinken met with the Prime Minister Benjamin Netanyahu in Israel and is urging more effort to protect civilians in its war with Hamas in the Gaza Strip. It comes as the House has passed the Aid for Israel bill. However, Bloomberg's Ed Baxter reports it may have a troubled future.
This is a victory for House Speaker Mike Johnson, but it looks as if it is dead to become law. Senate Majority Leader Chuck Schumer has been saying taking funding from IRS enforcement is a bad idea. And President Biden is out saying if it were to hit his desk, he would not sign it. House Speaker Johnson says it will get done.
There is absolutely no equivocation here. We have to stand with Israel.
And Republican Congressman Tom Cole says there are different paths to get the aid.
We have a lot of unspent money. We ought to use that toward a more important purpose, and that's Israel.
So the issue's far from settled. Ed Baxter, Bloomberg Radio.
Sam Bankman-Fried could be looking at up to 100 years in prison, maybe more, after he was convicted of a massive fraud that led to the collapse of his FTX exchange. Jurors in Manhattan deliberated for less than 5 hours. The old spring forward fallback discussion is ticking again. The debate over daylight saving time is raging again, with Americans preparing to set their clocks back 1 hour to standard time early Sunday morning. The American Medical Association says standard time is healthier and more natural because by getting darker earlier, it sets people up for better sleep cycles. Dr. Phyllis Z is with the Center for Sleep Medicine at Northwestern University.
When you're in standard time, your internal body clock, your biological clock, is going to be more aligned with a sun clock, which is, your environmental clock.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks are higher, yields are lower. America's economy adding 150,000 jobs in October, half September's gain. Unemployment rising to 3.9%, the highest since January of 2022. And wage growth, that moderated. This is the kind of jobs report that may keep the Fed on hold, according to former Fed Governor Randy Kroszner.
It's consistent with a somewhat softening labor market. I think the Fed will certainly be heartened by the wage growth coming down a bit over time. I think this takes the wind out of the sails of those who wanted to go further.
Right now, the S&P 500 up 32 points. That's a rise of 0.75%. We're at 4350 on the index. Dow Jones Industrial Average up 162 points. The NASDAQ 100 up 95 points. That's a rise of 0.6%. The benchmark 10-year yield 11 basis points lower, right now at 454. Oil's lower. Investors appear to be pricing out the possibility of the Israel-Hamas war spilling over into the wider region. And then you have the CEO, Jane Fraser, weighing whether to shutter Citigroup's municipal bond business. Profits from their muni operation have been a laggard. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash.
We're going to dig into that city.
Where's Joe Mysack
when
you need him?
We got Eric Kazatsky. He's going to come on here. We're going to break that down.
Still?
City cannot get out of the municipal bond business.
But if the street stops with muni bonds, do we still talk about it on Fridays?
If it's sponsored, we do.
You're trying to get out of
Sponsored
this.
by Citi.
Yes, exactly. All right, so today's news, obviously risk on day today. That's what a little softer than expected jobs print will do for you. Ben Emmons joins us here in our Bloomberg Interactive Broker Studio. Ben is a principal, senior portfolio manager, and head of fixed income at New Edge Wealth. Ben, is this market reaction, does that make sense to you today? I'm just looking at the 10-year Treasury. And we're back on October 19th, we were at 5%. Here we're 4.54%. So a big move in rates. Is that consistent with kind of what we saw today?
I guess the bond market is saying that this softening labor market is enough to not having to hike anymore. And that's what's sort of been then priced into yields. And then they go down from 502, the high that we were at, to this level. And we're still high, right? Because it's far beyond from where the neutral rate of the Fed thinks is. But, you know, it's sort of a reaction, I think, Paul, about, yes, you would, and after a hot quarter of economic data, you get some slowdown. That's what that GDP Now number already starts to indicate. And there's be some softness in this labor data. I have to say, though, this payroll report was not as bad, you know, because the leisure and hospitality and construction, all those sectors have been so hot, continues to generate jobs. So it's not a recession report. It's more like softness, and that's priced in as a...
So basically, people aren't buying bonds because they're worried about an oncoming recession, an imminent recession. They're buying bonds because they know now that the Fed is done, or at least that's what they think they know.
Yeah, I think that's exactly right, Matt. And obviously that's how the market read Powell's press conference too. Even though he says, like, you know, we're still not sufficient restrictive. And
he wasn't really enthusiastic about his no. You know, he wasn't really, like, on point in terms of the hawkish hold that we thought we might get.
Right.
It was anything but, right?
Yeah, but the market looks at it saying, okay, Fed, you're done. You don't need to do anything anymore. Sit back and let this economy slowly, you know, grind to a slower pace, and don't interrupt that with another rate hike, right? Because then you get maybe that recession faster at the doorstep. So I think yields are sort of probably here where we maybe should be for a bit, that you don't go down much more.
You know, Ben, it's still, to me, it is, you know, as an equity guy, I guess, like Paul says, or as a novice, which is really the truth, this is a lot of volatility for such a deep and liquid market. Why is the Treasury market whipsawing around as if it's shallow?
Yeah, that is a real problem, Matt, because go back to March of 2020, that was the wake-up call of that a big market like Treasuries can actually really get unmoored, unanchored, because everybody started selling all of a sudden. And because we're having so much supply being pushed into the market every week, as much as the Treasury is lowered a little bit for this quarter, there's a lot of supply coming in. And it's just the buyer base has changed and shifted, and there's a lot of buy and hold too, right? The households sit on a record amount of Treasuries. They're not trading those. It's the hedge funds or others are trading it. And that makes the liquidity very like thin, and that's, I think, risky.
This, by the way, this takes me off into a little tangent that I was thinking about this morning, because my colleague Sonali Basak was on the phone with Stan Druckenmiller this morning, and he's been really critical of Yellen the last couple of weeks. He's been critical of her for longer than that, but he talked with Paul Tudor Jones last week, and he was on CNBC earlier this week, and Sonali today, and he was saying, like, Janet Yellen is crazy. The Treasury Department should have been selling a ton of supply when rates were zero, right? Why on earth would a Treasury Secretary, who is clearly very intelligent and was running the Fed, not stock up on debt? Why didn't we sell a 100-year bond? Austria did it. We're smarter than the Austrians, for sure,
Maybe
right?
not.
How come?
So the irony there is that the Treasury talks to this Treasury Borrowing Advisory Committee, which are money managers, hedge fund managers, and economists. And the Treasury actually has been talking to that advisory committee saying, what about this 50-year bond, 60-year bond? And they got consistent pushback on it that there was not going to be enough appetite from the pensions and insurance companies in the United States for that type of debt. And I always question that, thinking like, well, wait a minute. You got the Japanese who were willing to buy that at a higher yield. You got, even in Europe, pensions who would buy that. But that pushback from the T-back to the Treasury, that's actually why we didn't issue that far out, because you're right, we should have done that, especially in 2020. If you can issue a 100-year bond at 50 basis points at that time, right?
Is that what Austria charged?
Yeah, something like that. So
50 basis points. Nice. And the committee was like, that's too expensive.
Yeah, exactly. Yeah, don't do it.
What are they building, I wonder, with all that money? What are they using the money for? I don't know. Maybe some more ski lifts.
Yeah.
That'd be cool. Hey, Ben, have we seen peak rates, do you think, for the time being?
So I'm not of that view, Paul. I'm still wary of that. The economy isn't so much quickly slowing down that we're at this recession point. Inflation showed last week much more stickiness. That's an issue. If any of these core measures are not coming off, if anything, it's actually some of them ticking up a little bit. Obviously, these UAW is having such success with those wage agreements. It's getting non-unions really interested there. So there's that wage pressure issue, plus to the liquidity problems that we talked about. Just as much as we move down fast with 50 basis points, we can be up like that in no time again. So on any kind of data point, so I'm more of a view like we're going to hit, probably going to try again 5%, maybe a little higher.
Okay.
Unless we are getting a series of negative data coming out. It could happen, but I'm not so sure about that.
So what do you think how do you think the Fed's taking today's payroll number? I mean, they could kind of maybe do a little victory lap around the Federal Reserve hallways maybe and saying, hey, everything's going according to plan?
Yeah, that idea that they say like we're restrictive, but we don't have to be sufficiently restrictive here because we have a labor market that's already adjusting and getting softer. That the sufficient restrictive would be a rate well above 5%, right? And meaning more, maybe higher than that. So I think you're right. They're probably looking to say this is once again going in the right direction. But I also noted from Powell's press conference that inflation is a real issue also for them. Not just a credibility issue, but just the fact that it isn't coming off as much as they like to. He did say that in between the lines. So I think that they're looking at this saying this still takes a long time to get to our target. It will probably take till 2025. Although in their forecast, that is a long time. So you would expect the Fed not to cut rates anytime soon. So the market's trying to price again in rate cuts by the middle of next year.
Yeah, look at the 5-year.
Right.
I mean, so I don't know, but I listen to surveillance, right? I don't know that much about bonds, but I hear Lisa Abramowitz.
She does.
And she knows.
Yes.
So she says the 5-year is kind of a proxy for rate cuts a little bit further out. And we did see those yields dive too.
Yeah, and that's what the market tries to do here, right? The moment you get data like this, it's sort of saying, let's pull it all forward and let's do this whole game again.
Yep.
And then price
all right,
it.
little 5 seconds. You're running the marathon?
Yes, I am, on
All
Sunday.
Right. All right, good luck, my friend.
Oh,
Thank you.
yeah.
Our boys, we'll
Good
got
for
somebody
you,
to look out
dude.
for.
Yeah.
Ben Emmons, he's a principal. He's a senior portfolio manager. He's the head of fixed income. He's also one of those crazy people that'll be out there on Friday running. I don't know where they're running to, but they're running. He's at New Edge Wealth. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Expedia has announced a $5 billion buyback after beating estimates. Bloomberg's Abigail Doolittle has those details.
In addition to the strong results, they beat both earnings and revenue. They put up adjusted earnings of $5.41, so not a small number. That was a 33% beat. They also put up revenue in a very solid way. That beat by about 1%. Hotels, that beat. Interestingly, airlines, a little bit of a miss.
Well, shares are still up right now. They're up about 16%. And Starbucks has a plan to drive growth. Bloomberg's Steve Potisk has that story.
First, Starbucks is telling investors the plan is to increase efficiency with supply chain improvements, saving $3 billion. The coffee giant also plans to accelerate store renovations while opening more locations that target on-the-go customers with formats such as double-sided drive-thrus. Starbucks is also pledging to double its 75 million rewards members in 5 years, in part by adding partners in the finance and hospitality industries. Starbucks also plans to boost barista pay through more hours and higher wages.
And shares right now up almost 3%. Shares of Maersk are taking a hit. They're down right now about 17%. And this after the shipping giant said it's cutting at least 10,000 jobs or 9% of its headcount. And that's due to lower freight rates and increased competition in marine transport. Now, its CEO tells Bloomberg that its order book and what's going to come in the next couple of years shows that they're settling in for a pressured environment for 2 to 3 years ahead. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, we have a risk-on day today. That's for sure. S&P 500 up about 0.6% off of the intraday highs, but still pretty solid to the upside. NASDAQ up about 0.75%. Yields pulling in as we've been reporting all morning. The 10 years off 12 basis points, 4.53%. We were just at 5% a couple of weeks ago, so a big move there in yields. WTI crude oil, that's off 1.6% here. We're just above $81 per barrel. And Bitcoin, it's off 0.6%, 34,700 for Bitcoin. With our news in New York City, here's Michael Barr.
Thank you very much, Paul and Matt. U.S. Secretary of State Antony Blinken held talks with Prime Minister Benjamin Netanyahu in Tel Aviv as Israeli troops encircled Gaza City and carried out intense aerial bombardments. During a news conference in Tel Aviv, Blinken says Hamas cannot remain in power in Gaza.
Hamas remaining responsible for governance, such as it was, and security, and posing an ongoing and enduring threat to Israel and its citizens is unacceptable.
Secretary Blinken also says Israel cannot resume responsibility and control of Gaza. He says more needs to be done to protect Palestinian civilians in Gaza, and without that, there will be no partners for peace. Meanwhile, the leader of Iran-backed militant group Hezbollah praised martyrs in Lebanon and elsewhere who have been killed in fighting since Israel and the Hamas war began. President Biden heads to Lewiston, Maine today. Last month, 18 people were killed and several others injured in a mass shooting. The Senate confirmed 3 top military officers, including the first female member of the Joint Chiefs of Staff. It comes as bipartisan frustration swirled around Republican Senator Tommy Tuberville for blocking hundreds more nominees. National Security Council spokesman John Kirby.
It's beyond ridiculous that this one senator is having this kind of an impact on our operational readiness.
Tuberville is protesting the Pentagon policy that covers service members' travel costs in seeking abortions. And finally, NASA is remembering Thomas K. Mattingly. The former astronaut died. Mattingly was the command module pilot for the Apollo 16 mission that landed on the moon in 1972. 2 years before that, he was named to the original Apollo 13 crew, but exposure to German measles had him replaced. Mattingly was played in the 1995 movie Apollo 13 by Gary Sinise. T.K. Mattingly was 87. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Matt.
Hi, Michael Barr. Thank you so much. We appreciate it. Coming up in the next hour, Zeke Fox. He's investigative reporter for Bloomberg Business Week, and he's the author of the new book on crypto entitled Number Go Up. Joins to talk about Sam Bankman-Fried's not guilty plea, because he was found guilty, and how it fits into the global crypto picture. So that should be a fun discussion with our good friend Zeke.
Didn't take the jury too long to deliberate.
15 minutes. I mean, they barely got their pizza.
The prosecution also used his book in the trial. Said, look at
Zeke's
page blah blah.
Ah, very good.
That's interesting.
Yeah.
I wonder how long he's going to get.
I don't know. I mean, can it be like consecutive and it could be a life sentence?
This could go either way. And this I mean, I don't know that Zeke will have any insight into sentencing in trials, but Elizabeth Holmes got 11 years, right? Is what someone pointed out at the desk today. But Bernie Madoff got like 140 years.
Yeah.
So where does SBF fall?
Yeah.
In the pantheon of ultra criminals.
And will they even appeal, I wonder, as well?
Of course.
But I don't know, it seems like it was such a, I mean, what do you appeal on?
I don't know, but this was only a couple-week trial, and I think he's going to say the judge didn't treat him fairly or give him what he wanted or whatever.
It's the biggest fraud in U.S. history. That alone dictates that he's going to go away for life.
Well, in U.S. history, it was offshore. You know, I would say Madoff still occupies that spot.
I don't want to be in that discussion.
Because this was in the Bahamas. If you were investing in FTX, well, you weren't supposed to be. So were you using a VPN? I don't know.
These are the questions. But anyway, we'll check in with Zeke coming up, and that'll be fun. He's all read in, as they say. Well, more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to break down those numbers from Apple. We've got somebody on the line who purports to be an expert. We'll see about that. We're also going to talk municipals, Matt, because it's Friday. And it is a perfect time to talk munis because Citigroup, I don't know, there's some reporting out there that maybe they're going to get out of the municipal bond market. They can't do that.
It's not a maybe, dude.
They've been financing like the colonies. I mean, that's how far back they go back in this business. So we'll check that out as well. Jay Hatfield, one of the smarter people we talk to. I don't know why he talks to us, but he's a really smart guy. He's the CEO at Infrastructure Capital Management.
I've been using his CPI-R index to look at inflation. I think it's fascinating.
Yeah, it's good stuff. So anyway, he's going to be in studio. We appreciate that. We'll break down kind of what we heard from the jobs day and the Fed and all that kind of good stuff. And let's kick it off here in this hour with Mr. John Tucker.
All right, Matt and Paul, Treasury yields are falling, stocks rising after evidence of a cooling U.S. job market. Non-farm payrolls increasing 150,000 last month. That's less than expected. Numbers like this do suggest the Fed's done raising rates. Right now, you have 9 of the 11 major industry groups in the S&P 500 higher interest rate-sensitive real estate stocks, best performers right now. Nadia Lovell at UBS is advising stock investors to buy any dips.
Yeah, there's more upside to the market from here, and so we expect the market to continue to rally into year-end. You still do think that, sentiment is still too bearish when you look at the AI bear indicators at the highest level it has been for this year.
The S&P 500, 34 points higher. That's up 0.8%. 4350 on the index. The Dow Jones Industrial Average is up 151 points. The NASDAQ 100 up 112 points. That is up 0.75%. The benchmark 10-year, 13 basis points lower. We're at 452. Apple shares, they have the biggest weighting in the S&P 500. They're lower on their disappointing forecast. Apple shares right now down 1.1%. Even though we recorded double-digit earnings per share growth, something like 14%, I believe. The New York City Marathon this weekend, and Ben Emmons is going to run it, our last guest. He's lucky because you have to be selected to the race's entry lottery. And the Journal put this together. The acceptance rate they figured out is 5.08%. That's just lower than the rate of admission to Brown University. It's also below the admission rate to Dartmouth. So.
Wow, I did not know that.
Did not know that.
But if you ever watch near in the park, the end of the marathon, you'll see folks running it who don't have numbers, who never registered, and they get chased away from the finish line by groups of volunteers. So it's like really weird to see this.
Yeah.
All right. Well, I think I'll be watching. It's always fun to watch. All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live as well on YouTube, so head over to youtube.com and search Bloomberg Radio. As John was just reporting, Apple reported some numbers, good quarterly numbers, but it's all about the outlook and China and stuff like that. So a little bit of a disappointment on some of the outlook. I thought it was just fine. The stock's only off 1%. But let's bring in somebody who knows this stuff for real. Anurag Rana, Senior Technology Analyst for Bloomberg Intelligence. Anurag, the big issue going into the quarter was we were told to watch China. What did we learn about Apple and its business in China?
Yeah, they missed the numbers in China. I think that was the big news, and that's the reason why I think the stock's selling off, along with the guidance, as you mentioned. And that's an area of concern because China is the growth market for them. They did mention on the call that iPhones did fine. It was really the Macs and the iPads that led to the decline. But frankly speaking, we have to see how the holiday season is shaping up for them in China. Otherwise, you're going to have another year of very poor growth for Apple. I think this is critical for them.
I'm just looking at the stock longer term. Usually I look at the 5-year, right? And they're up more than 3 times over the last 5 years, almost 4. I'm just pulled it out to 10 years, Anurag. Total return, 982%. That's not bad.
That's not bad.
Right? Can they continue that kind of growth? That's 26, 27% a year.
No, nowhere close to that. In fact, that's what Paul is going to ask me. He says, if sales are only going to go up 4 or 5% a year, why am I paying a 25 to 30 multiple on a stock? And I think that remains the biggest question is, even if they can grow, let's say, sales overall between 5 to 8%, can they continue to grow EPS in double digits? And I think that's really the big question for this year. If you remember 2023, we just ended for them, their sales declined by 3%. If we take away FX, they grew only 1%. So that's not a good thing if they're going to grow sub 5% next year also, and perhaps even after that. So they really need to show some growth over here.
All right. So in China, there's a couple things I think. There's the supply chain, and they got to de-risk that somehow, and I don't know how that happens. But the bigger issue, I think, for me is just in the next 1 to 2 to 3 years is demand for Apple products. Two risks I see. One is Huawei. They actually got a pretty good phone. And two, is this rising sense of nationalism? Do I really want to buy non-Chinese goods? How do you think about that?
Patriotism.
Patriotism. Thank you.
Yes.
Thank you. Better word. How does a company think about that? How do investors think about that?
They are making very strong statements that they are part of the ecosystem. They are very well entwined with the supply chain and the manufacturing, and they consider China to be a very core market for them. And I think they have got some support from the foreign ministry recently. Tim Cook just recently took a trip there. But frankly, every time there is some argument between U.S. and China, everybody looks and see what China can do to Apple next. And so it is a big risk for them.
What about the most populous country in the world? What can they do in India?
It is a long-term story. This is, things are not going to change there overnight because currently their unit market share in India is less than 5%. And Apple's, strategy is they're not going to just take the phone price down to a level that is going to be, ready for mass adoption. They're just going to wait for the middle class to get more affluent. And then as they become richer, they're going to get higher end products like Apple.
Well, how quickly is that happening? I mean, is the middle class growing in India the way it was in China 10 years ago?
Probably that same, somewhere in that vicinity. But if you look at sales in India have been very strong. But I don't think they can offset what's happening in China. Okay. But I really feel that India is going to be a very, very important market for them. But that's not going to that's not going to happen in the next 2 years or 3 years.
What about new products? I mean, I still remember getting the first iPhone, and it was so cool and so different. Now it would feel so slow and so bad. But since then, they put out the iPad and then the Apple Watch, but those really weren't game changers the way the phone was. Do they have anything on the horizon that could be a game changer?
I don't think the Apple Vision Pro is like that. I personally am not going to buy it, because the price is so high on that end. But things like AirPods do help with the average selling price of the entire package with the phone. So I think that's an important thing. But it's the services that's really growing in double digits. And actually, they helped them last night because whatever they lost on China, they actually gained from the services element. Growth was 16%, and that actually helps profitability of the overall company also.
I got an email overnight from Apple.
Yeah?
About my services. The subscription price increase was the email I got from Apple. What was this one? For Apple TV. Old, $699. New, $999.
Wow.
So what's that? That's like a 40% increase.
Yeah.
I'm paying it.
Of course you're paying it. Yeah, I'm watching. I like the morning show. I like the chemistry show. That's a new one. That's a good one.
Yes, we're watching both of those at the request of my wife.
Well, she's got good taste.
The morning show isn't very realistic.
It doesn't matter.
When it comes
Jennifer
to
Aniston. We're done.
I know, but like when Reese Witherspoon decides to quit on live air, first of all, she stops talking for like 10 seconds, and then she starts going off the rails. The producers would cut me off in a heartbeat if I did that.
All right, that's too much inside.
Nobody would let that go out.
That's inside pull. All right, very good. Anurag Rana, thanks so much for joining us. Anurag Raga. He is a senior technology analyst for Bloomberg Intelligence, joining us on those Apple numbers. That's just a nice way of saying he's old, I think, basically. We call him a senior analyst. So that's it. All right, let's talk munis. And we talk munis because it is promoted. It is sponsored. Focus on Munis is brought to you by Build America Mutual. Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be a part of Building America. Invest in BAM insured bonds.
Bam!
Boom. There you go. Eric Kozaski, he joins us. He's a senior analyst, senior strategist.
And by the way, it's very important that people watch us on YouTube. Stream us live on YouTube rather than just listening to the radio feed, which is great, I'm sure. But if you're watching on YouTube, you're going to see Eric Kozatsky here, and he's got a Bloomberg Intelligence banner behind him, which is great. And you're going to see a couple of little hands coming out behind the banner and sort of cutting up and eating his chicken lo mein, because Ira Jersey is like sitting behind him, stuffing down his lunch.
Exactly. That is how the sausage gets made right now. At Bloomberg Intelligence.
We hit him. We hit him. We didn't want to disturb the viewers on YouTube.
Exactly. All right, Eric, I got to start with this news that Bloomberg has here. Citi weighs shutting once dominant municipal bond business as profits lag. Tell me, the Citi is not going to get out of the municipal bond business.
It's quite possible. I mean, look, we've talked a bunch over the course of this year. You always ask how your banker friends are doing, and I told you they're crying in their soup this year. It's been a really tough environment. You know, obviously rates are the predominant story, and there's not a lot of issuance going on because issuers don't feel comfortable with the market and the volatility. So that's really sort of been the predominant story. Couple that with a lot of the bank policies that are prohibiting their underwriting in certain states, and it's just really sort of a perfect storm when they're looking for areas to cut costs within the bank.
See, I just think back to Citibank or whatever it's called back in the day. They were financing like colonies and stuff like that, and like T-ships.
That would not be allowed today, and Congress would get pretty angry at them. Certainly the Squad would not be down with that.
Right.
And, you know, the Squad and Elizabeth Warren and everyone else gets down on these banks for funding oil producers. They're like, how could you fund oil? You know, as they drive around in their big SUVs. And the banks will say, hey, we don't just fund oil, you know, we also fund these local municipalities. Look at the money we raised for, I don't know, Short Hills, New Jersey.
Right.
You know, they won't be able to do that if they get rid of this unit. They need to politically keep some kind of finger in the we raise money for your town bucket, right?
Yeah. Look, I mean, I agree. The problem is being in the muni business is a very expensive proposition. Public finance bankers, they're very expensive to keep on staff, especially in a market when you're not producing a lot of underwriting fees. Couple that with the fact that, you know, if you're running a prop desk for munis, you found out this year that, you know, holding long bonds can be a very unprofitable business as well.
Right.
So, you know, sort of the two body blows that they had to contend with this year, and it's, you know, they're looking at where they can sort of cut from the fat there.
But I mean, this is such a bad story to come out.
Yeah.
Because if you're a senior banker at Citi and Bloomberg gets a scoop that Jane Fraser is considering cutting your whole unit, you're going to automatically dust off your CV and go across the street, right? And the smartest and the best muni bankers at Citi are going to be gone, right? So you're left with the worst performers.
Yeah, but I mean, also that, I mean, any deals in the pipeline, I'm sure they're fielding calls from clients, and there's a lot of questions that they have to have answered that they necessarily don't have any more clarity on other than the article we put out this morning, right? So there's a lot of moving pieces here. I think the worst part for our sector is really just like an exit of you know, a firm of like that size. It's really going to impair liquidity in our space, and liquidity is already an ongoing issue as we've seen throughout the pandemic.
All right, Eric, so we've seen just in the past couple of weeks, 10-year Treasury go from 5% down to 4.52%, so a big backup in yields. What's happened in the muni space?
Well, big rally in yields, right? I mean, look, munis are participating to a much lesser degree. I think the opportunity set that we were hammering on about all through October is still there, but to a lesser degree, right? So talking about those tax equivalent yields, especially for folks in very high tax New Jersey or New York, for a single A muni, you're looking about 7.5%, 7.6%, certainly not 8.5% or 9% as we saw sort of mid-October, but certainly relatively attractive compared to where you can pick up on corporates.
All right, so as we go into the end of the year, any sense that there's going to be a rush to issue paper here to try to get something done before the end of the year? Are we going to see some new issuance pick up?
Yeah, I mean, hope so, right? As rates continue to fall, and if they drop, like, let's say, another 30, 40 basis points, I do think you're going to see some things pop back on the calendar that had sort of been on day-to-day status, or, sort of just maybe in, like, wait and hold till 2024. I think that there's some uncertainty going on with what's going to happen with the election next year, so you might see, sort of a last-minute flurry of deals come into the end of this year. That would be very good for our space, given that issuance is down.
Yeah, plus the fact that we're going to continue to have $2 trillion deficits, right?
Which for some reason bothers you.
Yeah.
I don't know why.
It's concerning, dude, because we're adding so much to the national debt. And I can't imagine people are only going to want 4.5% when we have a Congress that likes to shut down the government and kind of wants to default, right?
Seems that way.
All right, so who gets away using Michael Jordan in the analysis of municipal bonds? Why did you do that?
I mean, look, we're trying to come up with an analogy that would, make people want to read about municipal bonds, because let's be honest, it's kind of a dry subject area. But at the end of the day, right, munis are setting a record in a bad way, right? It's not the Michael Jordan three-peat, 3 championships. It's quite the opposite, right? 3 terrible Octobers. But not only that, it's been 3 successive years of building worse returns. We're hoping that November is really sort of the breaking point where buyers come into the space in mass. And look, we're only down 1.2% for the year. There's still a chance that we could finish in the green this year.
Interesting. All right.
We're rooting for you. We're pulling for you.
We're pulling for you.
Yeah, thank you. I appreciate that.
All right.
I mean, Paul doesn't care, right? Because you just collect your coupons.
I clip coupons.
You're not selling any of this stuff.
No,
You're not
of
trading
course not.
unis.
No, I'm buying them.
Yeah.
I'm buying them. But I get called every 15 minutes, so I got to buy some more new stuff. Eric Kozatsky, thanks so much for joining us. Eric Kozatsky, Senior Municipal Strategist for Bloomberg Intelligence, down there at Princeton, New Jersey. That is the heart and soul of Bloomberg Intelligence.
I've only been to Princeton, New Jersey one time to go to dinner at Brian Sullivan's house. Is it a sweet town to hang out in? I imagine there's like a great pizza place, an awesome pub, sweet little hotel, like a bed and breakfasty thing.
Yep.
Yeah?
Absolutely.
But judging from Ira Jersey's meal, they apparently serve free meals down there.
Oh, it is top notch.
What
Breakfast,
are we doing wrong?
Lunch.
What are we doing wrong here?
And they just renovated the entire facility down there, so it's
well. To be fair to us here, I think it used to be the case that it's good to go out and support the local economy, visit the restaurants around the office, get out and stretch your legs.
And the only place here with you guys.
And the only place you have in Princeton is the Tiger's Tail, which is great, by the way. The Tiger's Tail I've been drinking there since high school.
Right.
Great place.
Well,
but you can't go every day.
Well, this is the problem now with Midtown Manhattan. It used to be packed with restaurants. You had so many choices. Now there's very little to choose from.
Yeah, I got my pizza place. I'm in good shape. We got the Chipotle. We're all good here. Midtown is just fine. This is Bloomberg. All right, let's get some company news right now. Elisa Mateo.
Yeah, you can't forget the Chick-fil-A too, guys.
Yes.
Good morning. DraftKings. That's what we're starting with. They reported sales and player numbers that beat analysts' expectations. Bloomberg's Katie Greifeld has the breakdown.
Monthly unique players increased on the platform to 2.3 million in the quarter. That is a 40% jump from the prior year. And you also saw revenue per player increase as well. Now, DraftKings, it did post a third quarter loss of about 62 cents a share, but analysts had been expecting a loss of 69 cents a share. And just for context, DraftKings saw a loss of $1 per share in the same period last year.
Now, DraftKings also raised its fiscal year revenue guidance. Shares right now up about 9%. The United Auto Workers revealing new details about its tentative deal with one of Detroit's big three. Bloomberg's Kimberly Adams has that story.
Stellantis' tentative agreement to end the 6-week strike by the United Auto Workers includes $19 billion in new investment. They include reviving an idled Illinois assembly plant and building a new battery plant in that state. The union says Stellantis agreed to a card check process to make it quicker and easier for new workers at battery joint ventures to join the UAW.
Stellantis right now up about 2%. Sales of premium vehicles help BMW offset a sluggish global outlook for the industry. The German manufacturer's automotive operating margin exceeded expectations in the third quarter. Its EV sales, well, that also saw a boost. And Carvana managed to top Wall Street forecasts despite rising interest rates and high inflation. The online used car retailer slashed costs in recent months and restructured some of its debt to lower interest payments. Shares right now up about 12%. Those are the company stories we're following this hour. I'm Lisa Mateo.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yeah, I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks on track for the biggest one-week advance this year. Treasury yields, they are plunging. The benchmark 10-year 12 basis points lower right now. We're down to 453. The 2-year down 12, that's 486. And the long bond right now, 8 basis points lower, that's at 471. This all comes after job growth slowed by more than expected, and the unemployment rate rose to an almost 2-year high of 3.9%. So this is the kind of data that may keep the Fed from raising interest rates again in this cycle. S&P 500, 33 points higher. That's up 0.8%. 43.51 on the index. The Dow Jones Industrial Average is up 189 points. The NASDAQ 100 up 114 points. That's a rise of 0.8%. One of the standouts, Expedia shares, 16% higher. The travel tech company reporting third quarter earnings that beat estimates. They also announced a buyback of about $5 billion. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. Let's be honest, folks. Matt and I are just winging it here on a daily basis. That's why we really need to get smart guests to make this conversation real smart, and today's one of them. Jay Hatfield joins us, one of those smart folks we like to chat with, CEO, founder, and portfolio manager at Infrastructure Capital Advisors. And Jay, this has been a good week for risk assets here. I mean, we got yields pulling in 50 basis points on the 10-year. We got the stocks up 5 days in a row. What'd you make of the jobs print today? What are you making of this market right here that we've seen recently?
Thanks, Paul, Matt, for having me on again. We put out a note on Tuesday because things were looking a little bit bleak last week, I'd have to say, because you'd have great earnings reports and terrible price reaction in the market as a whole. But we did some work on near-term catalysts on bonds, and we saw everything really lining up for rally. So far we've been correct. And what we're really focused on is global growth, mostly in Europe, and nobody really ever reports on it, but you can easily get it on the terminal. That's where we get it. The European data is just awful.
Yep.
They're in a recession, as we had predicted. Mild so far, but it's only going to get worse. The ECB raised rates twice during the quarter, so nothing better is happening.
Yep.
And if you look even today, the unemployment is rising in Spain and Germany. They'd have the final manufacturing PMIs, 43. So that's bad. But also we had a weak PMI, which lowered our Atlanta growth rate. And then the final point is that, and we focus a lot on oil, is that it's not well discussed that gasoline prices came down 10% in a month. So that's 120% annualized. That's a little bit exaggeration, but still, that's going to show up in not just headline CPI, but more importantly, core. And this is what the Fed misses, and this is why they have all the nonsense from the 70s, because the real problem in the 70s, we had a 1,200% increase in oil prices. It bleeds through to core. So we're going to probably have cool CPI print in a couple weeks, and PPI definitely. And so this whole narrative that we're going to like 6% bond yields should attenuate. Having said that, we think that rates will really rally when the ECB starts cutting rates in the first half or even the first quarter of next year.
So you think they're going to cut imminently? They do have a two-handle on inflation. You know, even I mean, maybe because they're in a recession, or maybe because inflation was transitory-ish. We were talking to Cam Harvey yesterday. You know that guy? He's a professor at Duke.
Yeah, excellent.
And he was making the point that you have been making for a while. He said, look, it's ridiculous that this Fed thinks inflation is still, 3 to 4. When you take out the rent equivalent, which is backwards looking in the wrong way to do it, we're under 2. And I immediately looked at your CPI-R on Infrastructure Capital Advisors on your website. And you guys have 1.3% right now. So explain to us how you calculate that. You use core CPI, and then you take out the rent equivalent part, and you put in Case-Shiller, right?
Correct. You can basically do it in your head. Yeah. So because
not my head.
You can do it in your head.
But it's kind of nutty. But the CPI still is saying shelter's 7.2%. When it's actually going up a little bit, to be fair, but it's not likely to skyrocket. But so just assume 0. Case-Shiller's been close to 0, so 40% times 7 is like 3%. So basically, CPI is headline is overstated by 3%, and then it's only 33% a core. So it's overstated. Core is overstated by about 2.1%.
So, but so inflation isn't as bad as we think it is what you're saying. Still, cumulatively, it sucks, right, for consumers, especially since wages.
My New York strip is still killing me.
I don't feel like wages have kept up. Certainly mine haven't. And then growth, though, looked incredible, backward-looking, right? 4.9% in Q3. How does it look to you going forward? Because I feel like the consumer is getting hurt here, and charging everything and missing payments.
Well, no doubt. We have a saying that the average consumer is not an economist. So what we mean by that is they don't really care about CPI, whether it's R or whatever, because that's for 12 months, but they do care about 24. So prices have still skyrocketed over 24, and if your wages didn't go up, which is true for a lot of lower income consumers, and you don't own a house, you're definitely under pressure.
And by the way, CPI-R was much higher than core CPI for a while.
Correct.
Because I look back on the table, and you guys were up at 11, 12%.
Yeah, this is why we say the Fed is incompetent, because they just weren't even looking at any data. Like you can go back and say, look at PPI is actually reported. It was at 11 when they said things were transitory. So they need to redo their entire framework. And everyone should go look at the way the CPI shelter is calculated. It's ridiculous. They only update it at 1/6 every 6 months. So it's just designed to be lag. So the Fed should correct for that. In fact, the San Francisco Fed does correct for that.
But why? I just don't understand why they don't. I mean, for all the flack that Druckenmiller gives Janet Yellen, she's a super genius, right? And she's an economist, PhD.
Yes.
Like she's not. Now she's like a government, political kind of a hack. But she was like a serious economist.
It's inexplicable, and I'm shocked that not on this program, but other media outlets, that everyone comes on and says, not the Fed, but other people, that inflation's sticky when it's just flat out not sticky. It's actually contained. It has been since July of last year.
Have we seen then peak rates?
We definitely, there's not going to be another increase. And now, for the first time, we've been saying, I think,
to the federal funds rate, right?
Yeah, we've been saying for 4 or 5 months the Fed wouldn't increase rates, but they don't know it yet. Now they know it. Now they know it after this employment report. Very cool wages, rising unemployment. So that's what they look at, even though that's a flawed leading indicator. So the Fed is clearly not going to raise. ECB is not going to raise. They're going to cut. But, you know, all this really is going to start to impact because we're worried about the liquidity, you know, trillion. That's the other data we look at that most people don't. Global monetary base or supply, global liquidity really from central banks, down $1 trillion over the last 2 quarters. So it's terrible. That's probably not going to turn around until next year when the ECB is forced to cut. Because, you know, that's a simple way to trade the market, right? It's like if the Fed intervenes during the pandemic and says we're going to increase the monetary base by a gigantic amount, you get long. If they're sucking money, it's like taking $500 off free parking, you know, if you're playing Monopoly. Yeah. All of a sudden, you know, if you put it on, then all of a sudden everything's overinflated and everything's go-go, you take it off and it's bad. So we're in the takeoff phase, but I think we overshot to 5%. We'll see if we keep rallying from here at 4.5%, but next year we're confident we'll get below 4%, so we'll meet our 5,000 target next year at least.
But so you don't think like the bond vigilantes will come back and say, we're not going to finance this kind of deficit spending much longer?
We think there's
not at this rate.
That's a great question because we think there's way too much focus on the U.S. budget deficit. Because, like, I mean, I don't know. You
and
know,
Matt is concerned about it. So, are you going to try to allay his concerns?
Well, I think it's terrible from an economic growth perspective because there's something called crowding out. So, if the government spends money, it can't be invested.
Well, if they spend $900 billion next year servicing the debt, we're not going to have enough money to spend for the next pandemic.
No, it's a horrible thing, and it's a waste of capital, and it's terrible for economic growth, terrible for everyone. But it's not enough to drive global interest rates up 100 basis points. That's my only point. At the margin, it's bad.
Yeah.
But keep in mind that our Fed, strangely, if you look at the balance sheet, is actually still monetizing part of the debt because they're unwinding their short-term borrowing. So it can't be true that that's the key driver of global interest rates. It's bad. It's a terrible economic policy. Obviously, the budget process is horrendous.
And for taxes, dude, because now every time someone wants to cut taxes, they're going to say, we can't afford to. We got to do entitlements. We got to pay for the military. We got to pay $900 billion of service debt. So Miller and the rest of the middle class is going to have to pay half.
No, it's horrendous policy. And in fact, you know, we're actually pretty bullish about China because they save 45% of their GDP. So savings and investment drives economic growth. That's the only thing that does it. And that's just intuitively obvious. So if the government is reducing savings, we're going to have lower growth in the long run. So it is terrible, but just not enough to drive global rates to 6%, 7%, 8%. That's our main point.
We learned something again today.
Yeah,
we do. Every time he comes in here. Jay Hatfield, thanks so much for joining us. Jay is the CEO and founder and portfolio manager at Infrastructure Capital Advisors. He was a banker. He was, I don't know, a hedge fund dude. He's a skier up at my favorite place, Squaw Valley, which I think they've renamed it something. But still, Lake Tahoe, that whole area up there is just awesome. So
have they? That Squaw Valley was not cool?
No, it's something different now, so I don't know. All right, with our news in New York City, here's Michael Barr.
Thank you very much, Paul and Matt. Secretary of State Antony Blinken met with Israeli Prime Minister Benjamin Netanyahu and other Israeli officials in Tel Aviv today. In a news conference, Blinken echoed the Biden administration's call for a series of humanitarian pauses. Blinken says it will not only help ultimately destroy Hamas, but will allow innocent Palestinians the chance to receive much-needed aid and allow hostages the chance to be freed.
Civilians should not suffer the consequences for its inhumanity and its brutality. We provided Israel advice that only the best of friends can offer on how to minimize civilian deaths while still achieving its objectives of finding and finishing Hamas terrorists and their infrastructure of violence.
Secretary Blinken also says that Israel cannot resume responsibility and control of Gaza. FTX founder Sam Bankman-Fried went from the crypto king to now looking at up to 110 years in prison. He was found guilty on all 7 counts of federal fraud and conspiracy by a New York jury involving billions of customer funds. Eric Trump is expected to wrap up his testimony on the witness stand today in his family's New York fraud trial. Yesterday, he testified that he was never involved with or aware of financial statements that state lawyers say fraudulently puffed up the ex-president's wealth and the worth of their family business. A new report from the Centers for Disease Control and Prevention shows fewer high school students are vaping. About 10% of high school students said that they had used electronic cigarettes in the previous month. That's down from 14% from the same survey conducted last year. Erica Sword is with the American Lung Association.
That means that we're doing, as a nation, making important progress in preventing older teens from starting to use tobacco products, including e-cigarettes.
Global News 24